Okay, so first speaker is Gaynor Morgan. Gaynor, can you hear us?
I can hear you. Can you hear me?
We can hear you loud and clear. Fantastic. Right.
Brilliant.
We'll crack on because we're bang on schedule, which has never happened before. Okay, so we have Gaynor Morgan from Yorkshire Building Society. You would have all received this morning, which is their September 2022. I believe it's still version 1, not version 2, 3, 4, or 5. I'll come on to that later, of their products and processes. We're very lucky to have YBS on board as one of our lenders. I always say it was more difficult, actually. We was invited to actually come on panel. It was more difficult getting on their panel. It was applying for FCA regular authorization. It was such a lengthy process, but that I suppose means they've got brokers on there that they know what they're doing, which is the main thing for them. So you've all got a copy of this morning on PDF. A little bit about Gaynor first of all. She's been in with YBS previously, Norwich and Peterborough since 2004. We need to edit that. Since 2004, she spent 10 years working residential lending before moving into commercial lending, where she has happily been for nearly 8 years. She has experience in dealing with commercial investments, owner-occupied loans, corporate and personal buy-to-lets. Over the course of her years within the finance industry, Gaynor has enjoyed developing her knowledge and skill sets and has completed her, and I hate pronouncing some of these, CMAP, Sir DIP Bubuka of BB&C, and has recently passed a DIP FA. I don't know what any of those are other than CMAP. And here's her interesting fact. Gaynor is a second degree black belt and has won numerous British, European, and world titles over the years and has had the honour to travel around the world to do so. And Gaynor has also won Peterborough Sportswoman of the Year twice. So well done to Gaynor, as we always say every time she presents, because that is a great fact. Also means if ever there is a bit of a recession, they'll employ Gaynor to go around and do collections on people, I can imagine, because no one's going to argue, let's face it. Right, Gaynor, over to you. I'll see you in about 20 minutes.
Fab, thank you very much. Thank you, obviously, Tony, for the introduction and for inviting me back to be involved in the event. Also, thank you for giving everyone the heads up to ask some really difficult questions. Please do feel free to store those up for Tony later on. It's a great opportunity to be able to talk to you more about myself and YBS Commercial Mortgages. As Tony mentioned, my name is Gaynor and I'm one of the relationship directors here at the YBS, more notably within the South East London team, which is based in Peterborough. At YBS, we pride ourselves on being a relationship-led lender with a focus on dedicated personal service. The majority of our business is broker-driven, and as such, we're keen to maintain good, strong working relationships with all of our introducers. To help support that ethos, we try to operate a limited intermediary panel managed by the relationship directors like myself within our 4 regional hubs. These hubs are based in Peterborough, Manchester, Bristol, and Birmingham. Ultimately, it is overseen by the business development team. Unless it is a direct customer applications, we do only accept business from those that are on that panel. This enables us to build on those relationships, further understand what our introducers do, allow them to understand us further, and in turn lead into a more efficient and smoother process for all parties involved. Therefore, obviously, following this, if anybody does want to do any business with the society, then you would need to go through Tony and the team who are already registered with us to submit business. As Tony said, it was quite a painful process. With all of our applications, we do undertake a meeting with the clients, this providing us with the opportunity to run through the mechanics of the deal, give them the opportunity to discuss and ask us any questions, and just to ensure that everybody is on the same page as what's been requested and ultimately what has been offered. A designated member of staff is assigned to support you and your client throughout every stage of the process, this being from the initial application, from legals through to completions, and even after drawdown. Obviously, we want all parties to have the smoothest journey as possible, and for you guys to know that there's somebody to talk to at the other end of the phone should you have any assistance. So what's new with YBS since I last spoke with you all? Just moving on the slides. So we've recently introduced a broker panel. We call it a broker portal, sorry. The system's been developed alongside Salesforce and was introduced at the start of the year. We initially rolled it out to a couple of introducers just to test it out before we then started rolling it out to the rest of our panel from April onwards. It will ultimately replace the need for paper-based applications, and with all applications moving forward as of November through this system. It has enabled us to reduce the level of information that we need on applications, and also taking away the need for those wet signature applications, which helps also to speed up the process. It also adds as a simpler solution to providing documents, as when documents are uploaded to the portal, it does automatically get placed on the file that the lending managers are working on at that time. As with everything, it is a work in progress and it will continue to be updated and developed in order to improve efficiency and capacity. 2 new lending managers have been appointed in the South East team, which is where obviously the office I'm based out of. This to help with our growth plan. So this year we had a target of 375 million. I believe we are on target to hit sort of 450 by the end of the year. We've also been able to reduce the documentation that we ask for to support an application. We're continuously looking at ways that we can improve our processes and obviously also how we compare to the industry standard. So we have been able to implement that and get the information reduced down. What's in the pipeline to come? As we know, many individuals at this time are keen to secure fixed rates. Can't imagine why. So we do take that on board and we are working on getting a commercial fixed rate out, hopefully in the imminent future. Moving on, so what is it exactly that we do here at the YBS? So we offer a wide range of products as we try to cater for all needs of our clients. So we can consider commercial investments, semi-commercial investments, owner-occupied deals, corporate and personal buy-to-lets, HMOs and holiday lets. We do have a minimum loan of 500,000. Most of our loan terms range between 5 to 25 years, and typically we go up to the age of 75, although that can be based on the youngest party that is involved in the transaction. Lending is only secured on assets within England and Wales, and we are only looking to lend to clients, whether that's corporate entities or the actual UBOs who are based in the UK. So there's no element of offshore lending for us. So the buy-to-let range, as you can see on the screen there, we do currently only have fixed rate options for the buy-to-lets, and that's either a 5-year fixed rate or a 10-year fixed rate. The rates, as you can see, are on there. The 5-year fixed rate will depend on whether lending is overall under the 65% loan to value mark. The rates are the same, whether it's a corporate buy-to-let or a personal buy-to-let. There's no difference also whether you're taking a single asset, a multi-unit freehold block or a portfolio lend. The rates don't change. The differences that lie between the personal buy-to-lets and the corporate buy-to-lets, you'll see on the screen in front of you that there is a difference in the debt service requirements, with the personal buy-to-lets being slightly higher than that of the corporate buy-to-let. One thing to note about the debt service requirements is that it is worked on an interest-only basis. So even if the client does opt for a capital repayment facility, we will still work out the debt service cover based on an interest-only basis. So as I mentioned, obviously we do have a minimum loan of 500,000. Again, with the personal buy-to-lets, there is slight difference in that. As part of the YBS brand, we are also linked to Accord Mortgages, who obviously offer a space in the personal buy-to-let market. So in order to try not and compete in the same target audience, our large personal buy-to-lets criteria has been sort of designed around what elements they won't do. So we can look to consider large buy-to-lets where you're either lending 3 million plus of debt, you're lending on 6 or more properties, or the client in the background has 11 or more mortgage properties in their personal portfolio. Again, with the buy-to-lets, for either corporate or buy-to-let, as I mentioned, we can consider on an interest-only basis or capital and interest if the client requires. Lending on new build flats is restricted to 65% loan to value. We can consider first-time landlords. Studio flats are also a consideration, but we do look for the flats to have a minimum square footage of 35 square metres. Properties are required to be let on a standard AST or a corporate let up to 5 years on the lease. Oh, it's gone to, apologies. So HMOs, again, it is just a fixed rate product for this facility. So it's a 5-year fixed rate, as you can see on the screen, at 5.4%. The lending is based on it's not exceeding 75% of VP or 65% of the MV. Again, there is a slight difference in the debt service requirements depending on whether it's in a personal buy-to-let or personal HMO, or if it's in a corporate HMO. We can only consider properties that have up to 12 bedrooms. And whilst we can consider properties where the tenants in them are students, what we won't consider is purpose-built student accommodation. That's not something that's currently within our appetite. Moving on to holiday lets, again, just the one rate that's there, which is again a 5-year fixed rate. This is currently 5%, and we can offer up to 75% loan to value for those. Lending for the holiday lets is based on the net income from the property. It is taken into consideration any agent's cost, any business rates before we work out the serviceability. We will base lending on the lower of the passing rent or the market rent. That is the same for any of our applications, whether it's personal buy-to-let, HMOs, holiday lets, or commercial investments. If somebody is buying a holiday let for the first time, so doesn't have any figures, data to be able to use, we will look for the valuer to provide us with an assessment of the income, taking into consideration sort of seasonal trends. In terms of the properties that we're looking for holiday lets, we are looking for standard constructions. The property should be fit to either be occupied as a holiday let or put on a standard AST if needed. And we wouldn't be looking at taking anything that has an occupancy restriction imposed on it. Moving on from buy-to-let market, and sort of going through to the commercial and semi-commercial offering. So, societies in the market for, it looks like I think some of my tables have gone off that screen. I'm not quite sure where they've gone, so I do apologise, some data's gone. So we are in the market for both investment and owner-occupied proposals. The majority of our products are on a variable rate at the moment. As I said, we are looking to introduce a fixed rate, we just don't have one as it stands today. The variable products are individually priced, and they'll be done on the merits of the application. So you're taking into consideration things like the loan amount, the loan to value, location, type of security, tenant and lease breaks. Typically, you're ranging anywhere between sort of 3.5 to 4.5 over the Bank of England base rate. We do have 2 fixed rate products available where the loan is a semi-commercial asset, and that's where 50% or more of the property value comes from the residential elements. I will say that again because I know sometimes other lenders are slightly different on that. So ours is based on the capital value, not on the rental income split. So where there is 50% or more of that from the capital value, then what we can do is look to consider one of our fixed rate options. That's a 5-year fixed rate, 5.65%, and that's up to 70% loan to value, or a 10-year fixed rate, which is 6.05%, up to 65% loan to value. Both of those products do allow a initial period of interest only, with the ability to revert to capital and interest after. Apologies, I'm not quite sure where the data on that page has gone, but it is on the presentation that Tony's got with our products and processes, so he can send that out to you. One thing to note with our commercial deals is that we don't automatically obviously restrict the term of the mortgage to the remaining term on the commercial lease. Obviously, we accept that it's uncommon these days to be able to secure sort of the longer term leases. So we just need to make sure that we're comfortable with the outstanding debt position at either first break or at the end of the lease when we structure the proposal. Typically, you'll be looking at around that to be down to sort of 60% loan to value. Loans can be considered up to 75% loan to value, although the type of asset, type of tenant, along with a couple of other factors, will always see us potentially not being able to give that full amount. So as I said, while we can go up to 75%, it doesn't mean that every case will be offered that. Lending is generally based on the lower of market value, vacant possession or purchase price. We do have a slight exception to that, where the tenant in the property is what we define as a blue chip tenant, and that's governed by the Dun & Bradstreet rating. So you're looking at tenants with a 5A1 score. Those are the likes of Betfred. In those instances, we can look to consider lending on the market value, providing we don't exceed 100% of the vacant possession. With our owner-occupied proposals, where the borrowing entity is the same entity as the who's going to occupy the property, that's what we would class as a true owner-occupied proposal. If you're looking at the tenant of the property is a subsidiary of the company we're lending to, or another company owned by the same UBOs, we would tend to treat that as an investment and look at the rental income serviceability as opposed to the EBITDA serviceability. Most of the loans for the commercial are on a capital and interest only basis, but we are able to consider part and part or potentially interest only for the initial periods. But I would say if anybody wants to look at those, to give us a call and discuss those requirements. So repayment coverages for the commercial. So you're generally looking at 100% debt service requirement, and that's either at the higher of 6.75% or pay rate plus 3%. So if it's an investment, you're looking at the rent to provide that serviceability. If it's an owner occupied, you're looking at the EBITDA to provide that. If obviously somebody is already renting a premises and they're going to be vacating that and they can terminate the lease in a suitable period, we can obviously look to add back in any rental income that they're paying for their own property currently when we calculate the EBITDA. Also, if somebody is buying a property that has more than one unit attached to it and they want to rent part of that out as well as occupying part of their business in there, we can also look at the potential rent that they're going to achieve from those other units, adding that back in before we work out the serviceability requirement as well. Generally, as a simplistic calculation, I tend to look at, if somebody rings me and says, I've got income of XYZ, how do you think that fits? You're generally looking at 10 times the income. We wouldn't really get more than that. Don't currently have any appetite for hotels, bed and breakfasts, vehicle showrooms, and we also don't lend on land alone. So on the screen in front of you, you will see the details of our exposure limits and minimum landlord experience. Whilst you take a moment to just have a look at that, I'll just run through a couple of other key points about us. So we don't insist on business banking. We simply don't offer any banking facilities, so there's not an option there. It's not a standard that we'll request a debenture. We obviously understand the challenges around doing this. We can lend in personal and corporate structures, as well as lend into SIPs and SASs. When lending to a corporate entity, we will look to take guarantees from the directors and shareholders involved. The level of the guarantees, however, can be negotiated depending on the risk appetite of the application. Don't have an issue in lending to new SPVs, obviously all established businesses, whether that's property or trading companies. And we will always take a first charge over the property along with any assignment of rents for any occupational FRI leases. We do have direct access to our underwriters, so if there is anything quirky, unusual with an application, we just ask that you let us know, ideally more up front, so we can have that initial discussion with an underwriter instead of sort of progressing the application and finding out a little bit later that there's a little red herring in there. If anybody would like any further information on our products and processes guide, as I mentioned, Tony does have a copy of that and he can share that with you and the team. And that then only leaves me to say thank you very much for listening. And Tony's come back on, so I can pass you back to him at perfect timing and open the floor for any questions.
Bang on time. It was literally 10:35 0 seconds. Marvellous. Oh, blimey. That just don't continue. Gaynor, thank you very much. There's a few questions. First, the most important question. Steve's asked, a black belt in which sport? That was just literally as you started talking.
So I did freestyle karate kickboxing probably for about 10 years. So it's in that.
There you go, Steve. Okay. Yeah, I couldn't do that, unfortunately. I wish I could. Okay. We've got a couple of questions. I've also added a couple of questions myself, which might actually, because you've already answered a couple of your questions you said. But so Paul Mansell's asked, will you consider first-time landlords? I think that's probably asked on that slide there.
Yeah, so we can consider first-time landlords. That's not an issue. Obviously, they might just need a little bit more digging on those than an experienced investor. But yeah, we can consider them.
Okay. Hamid's asked two questions. I'll ask them in one. Do you have a minimum income requirement, and would you consider adverse credit applicants?
Okay, so we actually took away our minimum income requirement earlier this year. So there isn't a specific level, but I would generally be looking at what level of income the client has compared to sort of their level of outgoings and personal debt. We don't need it to obviously service the loan because it's generally an investment, but I wouldn't want to see somebody, say, with an income of £10,000 and they had £40,000 of personal debt. So it's kind of a common sense approach. And sorry, what was the other question?
Would you consider adverse credit applicants?
So we're generally a vanilla lender, so adverse isn't really in our appetite. Obviously, I'd be naive to think that nobody ever has any glitches, problems that occur throughout their lifetime. So if you do have something, I'd say minor, then give me a call about it ahead. But if it is a considerable adverse, then no, that wouldn't be for us.
Just this isn't a question anyone's asked. It's not on your list either. Do you use Equifax or Experian?
So we actually use Equifax for our personal searches.
Okay.
And Dun & Bradshaw for limited company checks.
Okay. It's only because we use Equifax. We search every client before it's placed with a lender just to ensure that. So just so everyone's aware. I'll be talking about this later on, but that just cuts out a lot of the time wasting. There's no point giving YBS a case where the guy's got 5 CCJs in the last 2 years because they're just going to say not for us, but that we then lost a day in the process. So, okay, so that's the delegates. Now to your questions and my questions. So, do YBS offer any green products or incentives?
So no, that's not something that we offer at the moment. Obviously, we know that the changes in legislations, I think you mentioned about the EPCs and that are coming in sort of later down the line. But no, any sort of green products aren't on our radar at the minute.
Okay, this is one that I've actually written down when you were talking. What is your typical client?
That's a good question. I wouldn't say I have it. Every client is different. I wouldn't say you've seen the same mix of clients that come through. But I suppose generally, going historically, we were never really a first-time lender. Never really in the market for first-time lenders. So we'd be looking at people with a little bit of experience in the property world already, 3 or 4 properties behind them. But I wouldn't say there's a typical client.
Clean track record, I think, is probably what we found that you like. You don't like people who've got a string of closed companies behind them that have left a load of debt with HMRC and the like. So
yeah, and I guess that comes down to our appetite on the adverse. We are very sort of vanilla lenders, so somebody with that type of background, again, whilst there obviously is circumstances, and I understand that, it's just not for us. As I said, a few missed payments here or there on sort of communications, mail orders, not mortgages, would maybe be something I can consider. But as I said, in terms of adverse, it is pretty vanilla.
Okay. Do you lend to offshore entities or applicants?
No. So I do think I covered this one earlier, but no, that isn't for us. We do commonly still get questions about those. But yeah, no, any offshore element is not for us.
Okay, and this is another one that I just wrote down. Who would you consider to be your main competitors?
Oh, that's a good question. So I suppose for us, probably I'd say the likes of Shawbrook may. Oh, actually, I'd be quite honest. It's changing quite rapidly at the moment with the changing in rates and the positions. I'm not quite sure who it is at the moment. But typically, where we place ourselves, where we ideally want to place ourselves, is between your high street and your challenger banks. So we're probably not going to be as cheap as your mainstream banking, but we can probably offer you sort of a higher loan to value than what they can. But we're probably cheaper than your likes of Shawbrook, Avamore, maybe Kent Reliance. But obviously we're a bit more vanilla than where they are. But as I said, with the rates changing at the moment so drastically between different lenders, exactly who we are in competition with in terms of that. I couldn't give you the answer.
You'd be surprised with the high streets at the moment, because the high street lenders that we use, believe me, you are cheaper than some of the stuff they're coming back with. At times it's like, wow, how have you arrived at 9%?
I better start putting some rates up.
Yeah, no. That's how they are.
No, we have recently, and as you know, Tony, it took me a little bit longer to get the presentation over to you because we have recently just put our rates up. So hopefully there won't be any imminent changes coming in.
Good. Just so everyone's aware, YBS are not a lender that are currently changing their rates every 3 to 4 days, but have a 10-day working turnaround on actually looking at cases, which we're finding a couple of lenders are doing at the moment. So we're in like a spiral of not being able to help the particular clients with some lenders because they never get to the business before the rate expires. So it's a bit of a problem. Gaynor, thank you very, very much indeed. We are slightly ahead of time, which is great. No more questions. So Simon will remove you from the room. Thank you for sponsoring today. Much appreciated. We'll speak to you very soon. Hopefully come and see us soon.
Yes.
This is before lockdown, I think.
No, we need to get in a visit. But thank you very much for your time, and hopefully speak to you all soon. Okay, Simon will remove you from the room, so otherwise you might close the whole thing down because you have the ability to do that. Good. So we have everybody. We have Marie Grundy, West One, and your official title now, Managing Director of Second Charges.
Yes.
There you go. So only high caliber people at the Specialist Mortgage Web Show, as you can see. And there's a recent photograph of Marie, as you can see as well. So with no filters there, by the look of things. Sorry, that's you. That is definitely you. I've known Marie for a very, very long time, everyone. So very long time, as both a competitor and also as a lender. So one of the loveliest ladies in the industry. She really is. So we will crack on. I'm only saying that because in about 2 slides' time, she'll be growling at me. So everybody, you should have received this today. This is West One's second charge mortgage range. You're probably aware West One also cover bridging, buy-to-lets. Might even be coming out with a regulated mortgage product at some stage in the future. We're not sure yet, but we're hoping they do. But this is purely second charges today. Nice and up to date, 30th of August. No changes afoot, I presume, as yet. Nothing planned.
Well, yeah, we just have to keep a close eye on the swap rates at the moment, unfortunately, because they're not behaving. But yeah, hopefully we're trying to minimise the rate changes as far as we possibly can.
Okay, and a little bit of history on Marie. She joined West One in 2017, is currently the Managing Director of the Second Charge Division, overseeing loan origination, sales management, distribution, and product development. Marie has worked within the mortgage market for over 25 years, starting out as a graduate trainee at Yorkshire Building Society. There you go, who've just presented. Prior to joining West One, Marie was Managing Director of Specialist Distributor V-Loans, giving her a unique insight into the market from both the perspective of broking and lending. Marie has also held senior positions within the special lending market over the last 17 years and was appointed to the board of the Society of Mortgage Professionals in 2019. Is that the one that I voted you in, or was that the...
that was Amy, wasn't it?
That was Amy.
Yeah, I've never forgotten that.
Yeah, there's others as well that she's headed up, but she's too modest to actually say. And there's me still creeping because of the next slide. I apologise. Which is, she once appeared in the Brian Adams video. And this is something she told us a long time ago, and then stopped putting in. She's a big fan of WWE wrestling and can often be seen on TV hitting wrestlers with her handbag. Sorry.
I know my son's grown out of it now, unfortunately. But I need to get him back on it, definitely.
Yeah, I've got some. My son grew out of it. I've got some WWE wrestling figures. If you want me to send them up to you, so you can reenact fight scenes if you wish.
A wrestling ring, yeah.
That's no problem at all. No problem at all. I'll go before you reach through the screen and throttle me. And I'll see you in about 20 minutes, hopefully.
Lovely. Thank you. I'll try and stay on time. Good morning, everyone. Thank you for the opportunity, Tony, just to speak to everybody today. So for those of you that are not familiar with West One, we are probably the fastest growing non-bank lender in the UK. We're part of the Emma Specialist Finance Group. So we have a diverse range of specialist lending products, including bridging and development, buy-to-let mortgages, and second charges. We are very committed to supporting borrowers that are generally underserved by the high street, and we're always looking at opportunities to expand our product range. So there are, hopefully some additions to our product range coming very soon. So definitely watch this space. All of West One's products can be accessed via Specialist Financial Services. So Tony is one of our most long-standing brokers, on at the very start with us from a second charge perspective when we launched back in 2017, and are complete experts in all of these areas, and particularly around second charges as well. So when I've done these presentations previously, we've talked about the impact of the pandemic on borrowers, but now obviously we're facing different challenges for homeowners across the UK. So, as always, borrowers now than ever need the intervention of professional mortgage advisors such as yourselves to navigate them through what, is expected to be quite choppy waters ahead. We've obviously got rising interest rate environment. We've got the whole debate on energy costs, and hopefully there'll be a positive package announced later today by the new Prime Minister. But households across the UK are really having household and disposable income squeezed to levels that they're just not familiar with. And the challenges around, payment shocks when they come to refinance, build that into, the increase in household expenditure and the inflation rates. And obviously, we've all got to really try and work with our borrowers and customers to try and make sure that they are going to be prepared for that. Now, one of the areas with second charges, which we'll speak about in a moment, is debt consolidation. But from a high street perspective, there are strict eligibility rules around debt consolidation. I'm hearing from brokers that further advances are becoming a little bit more challenging to be approved. And self-employed borrowers also facing more restrictive criteria from the high street. So these are the sort of borrowers that we are there to try and serve and help, and particularly prepare them from the headwinds that are obviously coming down the track. So why are second charges so relevant to you as advisors? So second charges have always been associated with debt consolidation, but I think particularly now more than ever, this isn't a lifestyle choice. This is something that a lot of borrowers are looking at their finances to see what they can do to increase disposable income. And it's really important that borrowers get the right advice around debt consolidation. Most of our master brokers will do a line-by-line analysis of each area of debt consolidation because they're highly experienced in this sort of loan purpose. And we allow debt consolidation up to 85% of the property value currently. So it does give borrowers the opportunity to try and really prepare themselves from what possibly could be coming in a few months' time. But second charges have more diverse reasons just than debt consolidation. So, for example, we see a lot of borrowers coming to us to purchase additional properties, either second homes, investment properties, and even Bank of Mum and Dad transactions. We came out with some criteria specifically to support Bank of Mum and Dad loans who wanted to perhaps release some equity from their property to help their children or grandchildren get onto the property ladder. And that's something that we're seeing more and more popular. And we know from 2021 figures that there was a high percentage of first-time buyer transactions that were helped along by parents and grandparents. So that's becoming more relevant. Second charges are also very conducive to home improvement. So we see a lot of home improvement loans coming through to us, varying size of transactions. So right from, it could be a relatively small improvement that borrowers are looking to make, or it could be more high net worth borrowers that are looking to make transformational changes to the property, which are obviously high end home improvement projects. And we've got some specific products to support those, which I'll touch upon later. We're also one of the few lenders to offer buy-to-let second charges. So we support part-time and professional landlords access second charge finance. And what you'll probably also see is that 5-year fixed rates have become much more popular over the last few years, but never more so than now. I saw a report, I think in July, 70% of mortgages taken out were on a 5-year fixed rate basis. So you're going to have more borrowers locked into longer term fixed rates who may need to access finance during the term of that fixed rate period. And then finally, product transfers. We've seen how much they've grown over the last few years. And I think with the squeeze on affordability, product transfers are going to become even more popular than ever before. I was looking at sort of the UK finance data on this, which sometimes is a little bit sporadic, but their Q1 22 review showed that 8 out of 10 like-for-like refinance were actually done on a product transfer. So they are overtaking remortgages month by month, and becoming a more popular way of borrowers securing securing a new rate on the mortgage. They're easy. They can go direct to lenders, as you know, that lenders are really quite aggressive in their contact strategy. So it can be an area where you can lose out to a lender if you're not proactive with your client base. The UK Finance also stated that there will be around 1.3 million borrowers who will reach the end of their fixed rate period this year. And of those, around 9% of them, they estimate, will have a disposable income less than 10% after the cost of living increases and the refinance costs. So there's going to be a sway of borrowers that just won't meet affordability tests for remortgages. The good news is they will be able to access product transfer finance, so they can still look to put themselves into a better position with your guidance. But that will also mean that any additional borrowing needs will not be addressed at the point of that product transfer. So again, it's really important that you start to think about second charges as a viable option for borrowers who may well not be able to go through the traditional remortgage route. So how can second charges add value to you? Well, we've talked a lot about helping borrowers mitigate against the effects of the current economic climate, and it is becoming a more popular alternative to remortgaging, further advances and capital raising options, particularly for borrowers taking out product transfers. The market at the moment is around 1.3 billion, and we've started to see sort of lending levels this year that we haven't seen sort of post credit crunch. So there is really demand fueling for second charges, probably for all the reasons that I've outlined to you. And it also gives you the potential of better customer outcomes, because if your focus is quite narrow on more traditional remortgage routes, it might not necessarily be the best thing for that customer. So the more that you extend your scope of service, it helps you retain your client bank, it helps you move towards more holistic advice, and it helps you give the customers the right advice first time. The good news with seconds as well is that you don't have to be responsible for the advice. So if it's not a market that you're familiar with, that's where specialist financial services can really lend their expertise and provide you with that service. You'll have various options, whether you advise or don't want to advise, but the crux of it is that we're helping the borrower get the right product for their circumstances. If you do describe yourself as an independent broker, you have to consider second charges alongside a remortgage and consider that as a whole of market broker. And then again, you will have the option to use specialist financial services to actually package that loan for you, which again is going to be hugely valuable to you. In terms of second charge opportunities, then the main sort of benefit to borrowers, it means that they can raise further finance without disturbing their first charge mortgage. So that could be they want to protect a fixed rate, because we know that when borrowers come to remortgage now, the rates are only going to be going one way. So they may have a longer term fixed rate that they don't want to disturb, because they know that that rate is going to be higher than the one they're currently benefiting from. Interest only borrowers are another example, and I have a case study for you to show just how beneficial that can be. Borrowers who are in early repayment charges, so again, a second charge would avoid early repayment of those, and again, with a double whammy of an increased rate of interest. And it could also be that they've had a change of circumstances since taking out additional borrowing. I think there's going to be more and more borrowers that are going to start to see credit blips because of the pressures on the household finances, which may mean that their high street mortgage that they've got now might not be available when they come to remortgage. And if the bulk of their borrowing is on a high street rate, that's a classic example of where a product transfer would really benefit that borrower, and use a product like a second charge to take out any further finance down the line. Second charges are also very flexible in terms of the loan term. So the loan term does not have to be the same as their existing mortgage. It can be shorter, it can be longer. So there's no requirement for that to be in tandem with the first charge term. And the loan purpose, pretty much every second charge lender lends for most legal purposes. And so, again, business purpose is one that you probably would struggle to place on a further advance. That's something that second charge lenders will consider. Tax bills, second property purchases, school fees. There's a really diverse range of loan purposes that we see come to us for second charges. Speed of completion as well. So there's a lot of lenders that will accept desktop valuations, drive-by valuations. The key thing is that the legal work is done in tandem with lenders, legal services and brokers who do an element of that work. So there isn't any post-offer delays that you'll see in the first charge market, because literally when the mortgage deed is issued, it tends to be that deed is returned within 7 to 14 days and the loan completes same day or next day. It really is that quick and simple. There's also sort of niche lending opportunities. So for example, we do what we call married sole applications. So you've got a borrower who's married. They don't particularly want to add on their spouse to the loan because the property might have always been in their name. We can lend in one name, even if the applicants are married. Equally, if you've got cohabiting applicants that have been together for more than 12 months, you can add the applicant onto the application, which is helpful sometimes if you need some extra affordability. So that's also an option. And it is an alternative solution, again, for borrowers that are looking to consolidate debt away from the constraints sometimes of high street lenders. So I mentioned interest-only borrowers. This is a classic example of an interest-only borrower who approaches their existing lender, wants to borrow an extra £50,000, but finds that when they do that, they're told that they can get the further advance, but it's conditional that all of the borrowing is converted to a repayment. So what should be quite a relatively low-cost transaction can actually really significantly increase the monthly payments. So for example, this borrower has a 300,000 interest-only mortgage fixed at 5 years at 1.75%, which we know is not going to be available if they apply for a 5-year fixed rate right now. And that would give them a monthly payment of £437.50. But by taking out an extra £50,000 and converting all of that onto repayment, that payment then becomes £1,411. So it's actually costing them an extra £1,000 per month to borrow an extra £50,000. If, however, they left the interest-only mortgage in place, took out a second charge on a typical 5-year fixed rate now of 5.99% on a repayment basis over a 20-year term, that would give them a monthly payment of £357.93, which saves the borrower £615 a month. So that's the kind of real-life example that we see, particularly for borrowers in that sort of circumstance. So in terms of our residential loan range, we have rates, variable and fixed rate options starting from 5.75% up to 30-year terms. We can lend up to 85% and we can help employed, self-employed, complex income cases, retired applicants. Our loans can finish by age 85. We also have an interest-only option. So I mentioned we've designed some products specifically for higher net worth borrowers. So we have a larger loan interest-only loan with a minimum loan size of 100,000 and minimum income of 50,000. But we're currently processing a loan for £750,000 for somebody that is buying some property. So that's a really good example of a completely different type of second charge borrower than you would expect to see. We can take up to 100% of regular overtime and commission for affordability, and all our affordability is done on an automated expenditure assessment. And we have some products without LTI restrictions, and that just means when you go to specialist financial services, they'll be able to give you some certainty around affordability right in that dip stage because of the way that we assess affordability. You've got loan sizes up to £500,000, up to a maximum of 65% LTV, but we can consider larger loans on referral. And the loan that I've just mentioned being a good example of that. And all of our loans are done on a credit assessment basis, so we don't deploy credit scoring. We look at each borrower as an individual, really try and understand what the backstory is, and just make sure that whatever we're doing is going to put them into a better position. So as I mentioned earlier, we also offer buy-to-let second charges. So again, it's very useful for landlords who quite often don't have the option of further advances because they're much more limited in supply for buy-to-let first charge lenders. So typical loans that we see are property improvements to increase rental yield or value. Obviously, we've got the issue of EPC rating coming down the track as well. So that's another area that our landlords can borrow for. It's often to buy a further property and increase, add to their property portfolio. So that's something we see either by way of raising a deposit or the full amount. And then we also see loans for personal use as well. So they might want to do some home improvements to their main residence, or there'll be an element of debt consolidation. And we offer loans both on an interest only and a capital repayment basis. And we offer loans both on a non-regulated and a CBTL basis as well. We were also the first lender to introduce a green second charge mortgage product, which I'm very proud of. So for any buy-to-let landlords who've got a property with an EPC rating of A to C, they actually benefit from our lowest available rates as well. And it's something we'd like to expand that product range to, because there's been really good demand for it. So we're pleased to be able to introduce that to the second charge market. And this is a case study about a very recent case that completed at the end of last month, actually. So this was a part-time landlord. He actually had a full-time position as a carer, but he'd already got one property in his portfolio and wanted to purchase another one. So he wanted a loan of just over £97,000 for the property purchase. He'd got an existing first charge with, I think it was Godiva, so struggling to get a further advance with Godiva. And we were able to arrange the loan. The income is assessed on debt service cover. So depending on the tax banding, it's either 125, 145 or 165% of debt service cover. We were able to arrange an interest-only loan at a rate of 6.25 with a monthly payment of £540. And the exit strategy was the sale of the buy-to-let. So quite a straightforward loan, and that's a typical sort of buy-to-let second charge that we see at West One. So again, we've got a range of different product types, fixed rates and variable rates, starting from 6.05. We've got loan sizes up to 350,000. And like I mentioned, we've got second charge green mortgage products within that range as well. And we can do up to 3 loans per borrower, up to a maximum of £500,000. And we can also consider licensed HMOs and expats as well by referral. So in summary, I think now is, if you're not already considering second charges, please look at the way this can help your clients, particularly as we move into some very challenging economic circumstances. And that is where the expertise of specialist finance will really come into play for you. You can really enhance somebody's life. We see lots of feedback in terms of how it's really made such a big difference by taking out a second charge, either because it's given them breathing space or it's helped them improve their home to such a standard that they would never have been able to do without it. And they are fully protected. We're now on the same level playing field as mortgages and have been now for about 5 or 6 years. So all of our loans are on a fully advised basis. And so all of our brokers have to take into account whether this is the right thing for the borrower. And as a lender, we also take a responsible view on that as well. Speed of completion is important. Like I mentioned before, you don't have the post-conveyancing lags that you'll typically see sometimes with a remortgage or a purchase. And there are niche lending solutions as well, where we can take a view on more complex income, particular borrower circumstance. And we really do, as a company, try and understand each customer as an individual. So that's it from me. Hopefully you've got some questions for me, and thank you very much for your time, and hopefully I've not overrun because Tony will shout at me.
No shouting at all. No, you're actually ahead of time for the first time ever, Marie. Thank you very much. Yeah, there you go. 5 minutes ahead. That was brilliant. Thank you very much. We've got a couple of questions from delegates. Francis has asked, what is your service level on second charges?
Yeah, it's highly responsive, actually. So when we receive a new application pack in, we aim to work that the same day. At the very worst, it falls into the next day at the moment. And that's the same for any sort of additional requirements that we've asked for when they come in. It's subject to the same service. So the service, I can honestly say, is really responsive at the moment.
Believe me, it's good. It is very, very good. In comparing to some in the market who maybe weren't as quick to increase their rates as they should have been, and then were inundated and had a 15-day working day turnaround. West One, we don't have any problems. No problems at all. Mohammed has asked, do you release funds on completion of the buy-to-let property which an applicant is intended to purchase, or is there no condition?
So if they're going through a purchase, if I'm understanding the question correctly, if they're going through a purchase of a buy-to-let, that has to complete. We don't do simultaneous completions. So usually we'd like to see that mortgage is in place for 3 months, unless if they're paying a similar payment or they've remortgaged, or obviously in this case it's a purchase, and we can see a track record. Sometimes we can take a view on that, but typically the buy-to-let purchase goes through first, and then the second charge would come 2 or 3 months after that.
I actually read that differently. I think that the way I read that was, can they borrow the money and keep the money for a week or two and then complete? So it's not a simultaneous completion.
Yeah, absolutely. Sorry, my misunderstanding. Yeah, absolutely. We will, if you're borrowing the money to purchase a property, if you're an inexperienced landlord, we will ask for details of the property purchase. But if you are an experienced landlord, we actually streamline the requirements. So providing, we're comfortable that that's what the money is being used for, then yes, we would just release the funds on completion of the buy-to-let second charge loan. And then obviously, if the purchase doesn't happen for a few weeks or months after, the borrower has that money in their bank account, and puts them obviously in a good position as well from a purchase, if they can be a cash buyer or can move quickly, particularly in this market, which we know there's a limited supply of properties for sale.
Okay, on to your questions that you set yourself. So what sort of demand are you seeing for second charges at the moment, and what is driving this demand?
So I think it's the things we were talking about. I think at the moment we're seeing, more borrowers being motivated to consolidate debts. And I think that is what is driving a lot of the growth in the second charge market. But aside from that, I think, like I alluded to earlier, I think there is almost a misconception that second charges are really for people that have got terrible credit, or it's the last resort solution. It really isn't the case. 80% of our borrowers have a high street mortgage. So we see very prime borrowers coming to us who have brokers that have been very sensible and recommending a second charge to them because it's actually the most appropriate solution for them. We also have one of the lowest arrears rates in the market, so compared to our peer group. So we do tend to see, higher net worth clients are coming to us, particularly since the launch of the interest-only product. But it is very vanilla customers that we're seeing coming to us for second charges, so not possibly that stereotypical borrower that you're thinking that you might see. But the growth in the second charge market this year has been, the highest it's been for a number of years. We certainly felt the first half of 2022 is our best half one ever, and we're probably going to overtake our best annual lending figure by next month. So we are really seeing increased demand, and it's not just us, it's across the market. I think a lot of lenders are seeing record levels of lending, unprecedented demand, so it's very strong at the moment.
Very much so. We're seeing exactly the same. Our second charge department is the busiest department we've got at the moment. But that's because the product is really designed for exactly. We've had, let's face it, we've had now 14 odd years of stupidly low interest rates.
Yeah.
My oldest son is 34. He's never known an interest rate environment like we've currently got, with rates going up. He's never seen it before since he would have turned 18 and probably applied for a Burton's card or something. It's just never seen it before, and a lot of people they've got debt out there. They've been living a life that is fueled by credit cards, and they've got a nice 80-inch TV on the wall, and etc. And they've been loving life. But now we've got rates rising, we've got credit card borrowing up. I saw increased by 750 million. Was it last month or the month before?
Yeah.
It's only going one way. So second charges, if you're not offering them. Now, I will stress, there has always been a little bit of pushback from mortgage brokers about offering second charges because they see massive packager fees, etc. Just keep watching, because a little bit later on, I'm going to show you how you can get these cases, actually steer the case yourself, but with lots and lots of backup from us. You can pretty much with no packager fees at all.
Yeah.
So
I I think as well, Tony, just to mention that we do help customers who do, I've mentioned we have like a lot of vanilla customers, but we also have criteria to support borrowers whose credit is not quite so perfect. So, you know, if they've got a satisfied CCJ or default, we don't actually take that into account for plan assessment purposes. We can help borrowers exit IVAs and DMPs. We can help borrowers who may have had some credit card arrears in the past. So as long as we know we're putting into the right position, we understand the story and what's happened to them, there's plenty of opportunities to help borrowers of different circumstances.
Okay. You mentioned about your interest-only product for higher earners. How successful has that product been, and what are the typical loan purposes?
Yeah, I mean, this is a product that's designed for a very specific sort of profile of borrowers. So these are borrowers that typically earn higher average incomes. So it's for borrowers that the main income earner earns at least 50,000 and on a joint base 75,000. And it's really, what we're seeing is really sort of high-end home improvement projects. We help one borrower who has a property in Ascot. I think he added on a huge extension, a wraparound extension, a swimming pool, a cinema room, and they're sort of typical loan purposes that we're seeing coming through for that. Also additional property purchases where, you know, there's been a run on buying UK holiday homes because of the pandemic, and that's obviously a trend that's continuing. So yeah, it's really helped that sort of borrow access sort of larger loans, and without having to jump through hoops that they might have to do going through a different route. And that's what we try and do. We try and look at what's missing in the market, what are the niches, what areas are underserved, and look to create product design to meet those needs. And I think that's a good example.
Okay. Last question. How concerned are you for UK homeowners as we move into a more uncertain economic outlook?
Yeah, I mean, I think we have to be concerned. You know, we have to be responsible. We've adjusted our affordability to meet sort of the higher cost of living. It's something that we're reviewing almost on a weekly basis at the moment. And I think it's really important for the reasons that we set out, which is where what can we do to help borrowers really face the payment shocks that, you know, we're going to see undoubtedly when, like you've mentioned, Tony, you know, a lot of borrowers haven't ever experienced rising interest rate environments. We've got, you know, another MPC meeting next week, I think on the 19th or in a couple of weeks' time. And likely it's going to go up at least 50 basis points again. So yeah, I think it's all of our jobs to really try and help homeowners navigate their way through this sort of next economic challenges and sort of house prices. Nobody's sure whether they're going to crash or the supply chain is going to prop up the sort of property market, but I think one thing's for sure, they're not going to be going up anytime soon. So all of these things are considerations for us as brokers and lenders, I think, over the next year or two.
I'm massively concerned because I mean it is a responsibility of all of us, I think, to just ensure that customers are actually getting in early and sorting out their issues, their affordability issues now, because I mean, it's unusual that we've got rising interest rates rising as quickly as they are, but also the way that the energy prices are going. I mean, we're seeing, there's just me, myself, and my wife in our house now, and our energy costs, because we've got a smart meter, the costs are probably more than when I have 4 kids living at home. They are more, and they're only going to go one way, which is up. So affordability is going to be affected massively. 0% balance transfers. Will they stay, or will lenders think we can make a few quid out of this? Now is the time, because unfortunately it's a situation. If you leave it too late with your customers, then that's when they get into do they pay their heating bills or do they pay their mortgage? And once they don't pay their mortgage, we know how difficult it is to actually get them something to help sort their problem out, and it's a lot more expensive. So getting early is really what I would say. Any direct clients we get, we're contacting them now and saying, look, let's give you a review. To see where you are and see how we can help. If we can help, if we can't help, if we can't do anything, because they're all in 5-year fixed rates, pretty much, if not longer. And it does really does mean getting now. So continue watching after the last speaker when I do my bit, and I can show you some how to actually do this and not penalise your client if you're authorised to give advice on mortgages. Marie, it is 11:15 exactly.
Yes.
I'm
did it?
absolutely amazed. Thank you so much.
Thank you.
Once do a presentation. It was 43 minutes, and I was like, "Oh no, this is." We did finish quite late that day. But this one, bang on, absolutely fabulous.
You.
In fact, it's just gone 1 minute over because I'm yakking too much. Marie, thank you very, very much as always. I'll see you very soon.
Thank you.
Simon will remove you from the room. Don't do it yourself. No good. Simon's done it. And our next speaker is a very old friend of the show. He's probably done more of our shows than any other person. We have Andy Virgo from Lendinvest, who is Director of Buy to Let. So, yeah, another one. Andy, can you hear us?
Hi, Tony.
Yeah, how you doing?
All great, thank you.
Marvelous.
Loving life.
Absolutely loving life. Now living up in Newcastle, because during lockdown he decided he had enough of the South Coast, so he's now living up in Newcastle and having a whale of a time by the sounds of things every time I speak to him. So always got a smile on his face. So there you go. Right, we will crack on because we are still bang on time. So everyone, you should have received these two items today via email, which is Lendinvest Buy to Let rates and criteria guides. Have a good look. I'm going to come on to some stuff about Lendinvest that Andy doesn't know I'm going to cover, but in a little while, because I've been quite heavily involved in a couple of our deals in the office recently. And some of the stuff I saw come up was absolutely fantastic as far as Lendinvest was concerned. So a little bit about Andy, first of all. Joined Lendinvest in 2017 as a BDM with over 30 years experience in the mortgage industry. He supported Lendinvest's entry into the buy-to-let market, which is still, by the way, the best new launch I've ever seen in all the years I've been doing this of a lender. What really was game-changing for the specialist market, including the development of its product proposition, and has assumed full responsibility for the product as a whole. Andy previously worked for NatWest and Interbay Commercial and successfully operated as a mortgage broker both for Christie Finance and his own property finance brokerage. And his interesting fact, he was once a red coat at Butlins. So not sure how long ago that was, but probably about 15, 20 years ago when he was in his early 20s, probably. So there you go.
1983. Easter of 1983.
Blimey. There you go. So 1983. Have you still got your outfit?
No.
No?
Would
you
you
still
fit
get it No. I feel your pain. Right. I'll let you crack on, Andy. I'll see you in about 20 minutes and over to you.
Thanks, Tony. So hi, everybody. Looking forward to going through this, which I hope is very much a kind of an educational presentation around some topics that are right in our faces at the moment. So just a little bit about Lendinvest. We were established 2008 as a bridging lender, originally called Montello, but changed our name when we decided that we were going to move in the direction that we've actually moved to now. As a bridging lender, we eventually added development funding for large development projects, and that's a very, very successful part of our business. As Tony said, I joined in 2017 very much with the sole purpose of getting the buy-to-let proposition up off the ground, which we did towards the end of 2017. And so we've gone from zero in the last 5 years. We've gone from zero to having looking to achieve £1 billion of lending this year. Unfortunately, the world is conspiring against us, so we're revising those numbers down. But we've certainly made some good headway into that number. So we're a fintech lender. We're pioneering a lot of use of technology in the industry. You'll have seen us do, or you will see our processes absolutely paperless. We aim to grow our business, move into additional sectors of lending. We introduced regulated bridging this year, which is going very well. And last summer, we launched on the stock exchange. So we IPO'd. We managed to secure a £40 million investment from that, which is all going into the development of our technology. So we already have a purchased off-the-shelf portal for our buy-to-let proposition. We've got our own developed bridging portal, which is phenomenally slick and quick. We're building residential specialist resi, which we aim to launch by the end of the year, into that new portal, and then move buy-to-let into it afterwards. So linked to Salesforce, very, very slick, very technology-led. It's going to be a real game changer. So what am I going to talk to you about today? Well, it would be wrong of me as a lender and involved in buy-to-let not to talk about what's going on with the interest rates. So we'll go through that in a little bit of detail. And then we're going to highlight some things that are really interesting from a landlord's perspective, and give you guys something really important to take away from today to go and talk to your clients about. Update on criteria, always important, and the fact that how we're working so hard to deliver from a service point of view. So what on earth is going on with interest rates? Well, you've seen that the Bank of England base rate has gone up 6 times in a row. And yes, a few people have talked about it already. There's a mooted 0.5% rise that's going to be coming next. And we're on our way to in excess of 4% as a Bank of England base rate. As Tony said, we've had it so benign in terms of a period for like 14, 15 years. We've had very, very low interest rates, and it's allowed us to kind of have a very consistent approach to business. And as a lender, we're profitable. A number of our peers, I won't mention any names, a number of our peers are not profitable, but as a lender, Lendinvest, we're profitable. You'll see that from our year-end announcements that we put out now that we're a listed company. The MPC are meeting on the 15th of September. Marie intimated that. So that's going to be a big deadline now as to what's going to be announced in terms of interest rate rises. And everything's conspiring against us from an inflation point of view, from a war in war in Ukraine, supply of goods from China because they're in a full lockdown. There's all sorts of things conspiring against us. So interest rates are rising. But how does that transpire into buy-to-let and the buy-to-let rates? So here is one of our own slides where we track the 2-year and 5-year swap rates. So this is where we base our lending from. Let's forget about the word SONIA and swap rates. Say that when you're drunk. But it's more about the cost of borrowing. So you can see that from January 22, that red dotted line, there's been a massive spike in the cost of money. And that is what's causing us all problems. Now, some lenders have gone early. We went early and we upped our rates. As I said, we wanted to remain profitable. There's no point in just generating loans and business to lose money. And ultimately, we've all, as lenders, arrived at the same place now, which is rates that are very, very similar to each other. Even when you compare the fact that, some of us are funded by deposits, some of us are funded by financial institutions. We're funded by the likes of the National Australia Bank and Citibank and JP Morgan. So this is the chart that we kind of look at in terms of analysing swap rates, the SONIA cost, which replaced LIBOR, that ill-fated bank-rigged way of organising the cost of money. So SONIA came in earlier this year. We adopted it, and these are the swap rates. So this is where we take these rates. We need to add a margin onto that for operating costs, and then we produce our interest rates. So this chart's quite busy. Let's just focus on the cost of money over 5 years. Now, this slide was put together at the beginning of September, so right last week, to send over to Tony. And at that time, the cost of 5-year money was 3.32%. You can see the red arrow there pointing to that line which says 5-year current on the left, 3.3%. Now, that 3.32% was how much we were having to pay for the money. A year ago, on the right-hand side, the 31st of August 2021, the same money was costing us 0.469, so 0.47 as an interest rate. So when you consider that the rates have not gone up by 3%, you've not seen us with rates above kind of in the 6s. Historically, a year ago, we had rates in the 3s. You've not seen rates in the 6s. We're currently, with our 5-year fixed rates, we start at 4.84. So if you look at that's only gone up from sort of 4.6 back in June. Back in June, the money was costing us 2.1%. So in the month of August, the cost of money's gone up a whole 1%, which is just incredible. Now, this, as I said, this is a slide from a week last week. The actual updated slide from today shows the cost of 5-year SONIA, or the cost of money from yesterday, is now 3.5%. So if we've got a product at 4.84, as you can see there, and a cost of money at 3.5, the margin that we put on top of that for ourselves is diminishing. So we're not profitable. So that is why lenders are moving rates the way they are, as quickly as they are, because people want to remain profitable. So let's look at the kind of the monkey in the room, which is, you know, what are people doing about notifying brokers when they change rates? So if I've got a portfolio application in now, and that portfolio application came in, say, middle of July, when the cost of money was below 2.1%. When we complete on that portfolio, the cost of money for us has gone up 1.5%, but the interest rate stayed the same. So some of the deals we're completing at the moment, we're actually losing money on, significant, hundreds of thousands of pounds on each deal we're losing money on as a lender. Now, you can balance that out over a period of time. So, and there's all sorts of hedging that we can do in the background. But ultimately, if we're going to change rates, what we don't want is to signal a stampede. So if we announce today that we're going to change rates next Friday, give people plenty of time to talk to their clients and get their applications in, the stampede of applications that come in would be unsustainable, not only from a service point of view, but from a loss point of view. You know, when the money's costing us, say, 3.5 as it is at the moment, and we've got interest rates at 4.8, knowing that the rates are going to go up, it's really silly of us to kind of advertise and give people lots of notice to get applications in. So we're trying to protect our business. So apologies for the very swift turnarounds and short notice when it comes to rate changes. But it's unfortunately what we have to do to protect ourselves within the industry. The alternative is, you know, you'll see banks disappearing and stopping lending. So hopefully that's a bit of a background as to what's going on in terms of the cost of money, how quickly it's rising, and some of the challenges we face as a lender, which unfortunately you guys have to suffer from when it comes to communicating with your clients. I think the biggest advice I could give from here, and I might mention this later on, the biggest advice I can give from here is to make sure that you complete any mortgage with us and with any lender within the validity of the offer period. So the offer period for us is 90 days. Complete that mortgage within 90 days. Stay on top of your pipeline. You know, you've got some different sizes of brokerages. You've got Tony's very large brokerage with a very comprehensive back office operations department that stays on top of the deals. You've got small brokerages that are always focusing on getting the next deal in, and letting them run their course. Never has it been more important for people to stay on top of any of the cases and make sure that they're being pushed through the legal process to make sure they complete within the offer validity period, because absolutely no way are we extending offers beyond their validity period, because it's just loss making. It's crazy. So apologies about being honest there, but that's the education side of it. A little bit more education. So EPCs, did you know that 57% of the houses in the UK are poorly insulated? Lots of various statistics coming out now around EPCs and the looming deadlines for landlords to get to the level of a C rating by 2025 for new tenancies, and then 2028 for all tenancies. So the average EPC in the UK, England and Wales, has only increased by 2.85% or 2.85 points in the last 12 years. So there's not much been happening to improve the energy efficiency of properties. Now, there's lots of studies, and Tony's referred to the brilliant Shawbrook publication, which we've all read as lenders, and has been repeated by many people who have commentated on the subject. Landlords, from their point of view, that they think that potentially it's going to cost around £3,000 to upgrade their EPC rating. So 77% is a statistic that's come out from a Paragon Bank report. So these statistics are from the Paragon Bank and the Shawbrook report. Shawbrook are commenting that it could cost as much as £10,500 per property. And I'm going to come on to some more specific numbers in a minute. 15% of landlords are unaware of the proposed EPC legislation changes. So that's the message to everybody here that's got clients that are portfolio landlords. Now is the time to be talking to them about, are they aware of the upcoming EPC changes? And when it comes to funding those changes, it's really interesting that kind of 60% of landlords say they're going to use their savings to fund improvements, which is interesting, coming out of their own pocket. 8% intend to use further advanced borrowing. When you think about it, if you've got a property in London, if you've got an average, say, let's say it's at £10,500, to remortgage or get a further advance on your mortgage on a London-based property, London and the southeast, £10,500 is not going to make much difference when it comes to the loan to value. Flip that to the northeast, Wales, northwest, maybe some Scotland, part of Scotland as well. And I'm seeing properties advertised up here for £85,000 to £120,000. You're talking about increasing your loan to value by significant amount in order to achieve a £10,500 further advance to fund some of the work to get your EPC rating up. And when you think about it, is that a viable amount of money to spend on a property? So 8% are looking at other loan facilities. So that would be credit cards or personal loans. 7% are looking to release equity across the whole of their portfolio. But then look at that, 27% are planning to increase the rent. What if, and I'm sure we're going to talk about it later on, what if there's a rent freeze? Now there is in Scotland. What if there's a rent freeze in England, not allowing people to increase rent? How are people going to fund that work? So again, timing. Now is the time to speak to landlords about the EPC challenge. Let's look at it in a little bit more detail. Now, I appreciate this slide is really hard to see, but I wanted to provide a slide this is a slide from CAMA, who are an Irish kind of think tank. I wanted to provide the slide as opposed to just writing the numbers out myself. But ultimately what this is saying is that the main things that you can do to improve the EPC rating of a property is get energy efficient light bulbs, get some draft proofing, and some cavity wall insulation. And each of those three things will give you an average increase in SAT points, which I'll detail in the next slide. If you want to go the whole hog, then you could be looking at solar panels. So let's look at those in two parts. Bulbs, draft proofing, insulation. The average cost is just over £1,000. You're going to increase your property by 5.7 SAT points. So you need to understand where your starting point is. Where are you on the on a SAP rating? And it's very easy to find out your EPC stats for your property by going onto the government website. If 5.7 SAP points isn't enough to get into the right bracket, then potentially you're going to be looking at solar panels. Now we've got a long list. I've got a hell of a long list of little things you can do to incrementally increase your rating, but it was too much information to put onto a slide. So I've pulled some key data here to kind of give you a flavour of what's going on. So if you wanted to add in the cost of the solar panels, that's going to put your bill up to £9,000, and that's going to increase your SAT points by 10.5. Do you know what? The amount of inquiries for solar panels recently has gone through the roof. I think there was a statistic along the lines of 33,000 solar panel installations are currently underway, and there is now a waiting list. Supply and demand, are solar panel installers going to be able to get the stock they require? Supply and demand, is the rate going to go up? The cost going to go up? The price of stuff's not going down at the moment, so that cost for solar panels is definitely going to increase, but noting the number of people that are adding them to properties. So let's flip that back to that kind of original slide, and let's look at the outcome of what we've just talked about there. So if you've got 10.5 SAT points from doing all of those things and costing you kind of 9-10 grand, you're going to increase your SAT points, increase your points by 10.5. If you're in a low D currently, which is 55 points, and you want to get to a low C, which is 69 points, that's a difference of 14 SAT points. So I've just proved there that solar panels and light bulbs and insulation and cavity walls, draft proofing, that alone is not enough to get someone to the right level, to get to the right EPC rating, to get to the right emissions level for their property to then let it. So what's going to happen? I think those properties will get sold into residential stock. If I was a landlord, especially in the Northeast, I'm not a landlord, I've been divorced too many times. But if I was a landlord, then I'd be selling my property and I'd be going and buying a new build. And as soon as new build companies, I've just moved to a new build estate, they'll probably put a limit on the number of rental properties that people can buy. So it's a really interesting time as to what's going on with this challenge that landlords have, and it's really, really important to make sure that people jump onto it straight away. So as far as we're concerned at Lendinvest, what are we doing? Well, we're trying to do our bit in that we launched an Epic range, and it's a play on the word EPC, of course, Epic. Our Epic range provides a discount on our interest rates for landlords who are buying a property rated C to A. Now that 10 basis point discount off of the standard rate is kind of us rewarding people for exhibiting good behaviours. It's really important that we try and do more though. So we have an ESG team in our business that are currently working on how can we do more? What can we invent in terms of products? What type of funding can we achieve in order to allow us to assist existing customers of Lendinvest, kind of get the money out of their property in order to improve their EPC rating. So moving on now to the third topic, criteria. September saw us kind of release, or sorry, end of August really saw us release lots of new criteria. And just a little bit tongue in cheek, if our criteria was a football team, I think it would be Bournemouth. More importantly, it would be Bournemouth's defence. Our criteria is wide open, much like Bournemouth's defence against Liverpool. Poor old Bournemouth. They're having a rough ride in the Premiership. Yeah, as far as criteria goes, wide open. Never have we been able to accept more cases, and it gets more complicated for you, which is why the likes of Tony and the team at Specialist are continually updated on the quirks and the criteria that we have, and very often inquiries will come in from Tony and his team for us to try and bend the edges of an application and work together to have a kind of word with us to try and make sure we can fit a square peg into a round hole. So here we are assisting now for the first time HMO landlords. It's something I've been looking to move into for a long time. There are, as far as small HMOs up to 6 bedrooms are concerned, we were happy to assist first-time HMO landlords. But you've also got many pockets around the country that have got HMOs in that are in Article 4 areas. Now, for a long time, there have been a couple of lenders that have looked at valuing those not only on maybe a bricks and mortar basis, but also on investment, a yield-based valuation. So we added that to our proposition that we can assist in an Article 4 area, a landlord with a small HMO, and value that on a yield basis, thus allowing them to gear up, raise more from the property. Kitchenettes, dual kitchens get an awful lot of inquiries for this sort of property, and we've increased the loan to value on those from 75 to 75%, was 70 to 75%. Also introduced hybrid properties. Again, there are properties out there, as some of you may know, that you've got part of it's like a multi-unit freehold block, and you've got an annex that's an HMO. So the ability to fund hybrid properties, MUFB, HMO kind of properties, is something that's very much open. And as a business, we are very much the limited company borrower's friend. People that are moving their properties from personal name into limited company, they're incorporating. We're assisting those landlords, and as such, you hear about lenders limiting landlords to just like 4 SIC codes. We have 56 acceptable SIC codes, so we're able to assist many more landlords who have limited companies. That the exception is not trading businesses. We cannot assist trading businesses, but there are many SIC codes more than the standard lenders that we can assist with. Tier 2 pricing, you've got your challenges that some landlords are facing with some arrears, some that's affecting their own personal credit score. We've had Tier 2 pricing in our standard product range for a long time. We've extended that to HMO and multi-unit freehold block. And actually, behind the scenes, we're now moving towards where we discover somebody has a credit record unlike that they've told you on the application, and we're deducing that they're actually in a pretty poor position when it comes to their financial footprint. We're actually going back to customers and offering to assist them at bespoke pricing levels. So we're not here to say send us all your rubbish deals, but where we come across something that is a bit of a challenge when it comes to the credit worthiness, we're able to potentially help those at a cost. And then finally, from a criteria point of view, we match our criteria now, and it took a little while to get there from the legal point of view, but we match our criteria now in Scotland, England and Wales. Scotland, there have been many challenges, but we've managed to negotiate those challenges and navigate those challenges and get to the point where we now have a lending proposition that is literally the same across all parts of the UK. Now, one thing that we do as a lender is we listen to the feedback from brokers, and we've had a torrid time with solicitors. Solicitors are a bane of all of our lives, and we've had quite a restricted panel over the years. As I said, we're a lender that's only 5 years into this journey and incredibly busy. And from that point of view, we've had to learn as we've been going along. We've always focused on speed. Everything that we're in control of, we do very quickly, we do very swiftly, we do very simply. But it's the things that are outside of our control that really get our goat. So in order to make sure that we navigate that, I'm using the word navigate a lot, we're looking at technology and how we can use technology to improve the process. Now, everything that we stand by is written on this slide. Our technology will disrupt, our service will differentiate us, and our people are dedicated. And that way we all win. We're looking to remain competitive and looking to invent our own software, proprietary software, to drive forward our technology. Now that has resulted in a link up with Smooth. Smooth was formerly called ULS Technology. Now these guys are effectively a solicitor legal panel. Now you, as brokers and clients, are able to access through our portal almost the solicitor of your choice. No longer do we need a solicitor no longer do we need our own solicitor to act for us. We're allowing solicitors of your choice, of your decision, of your choosing, to act for us and for the client on a dual representation basis. So we now have tens and tens and tens and tens of conveyancers out there that are able to act for Lendinvest. And as time goes by, we will add more of those conveyancers to our panel. When we talk about technology, some of our peers who have access to Smooth or ULS Technology, it's very much not part of their portal, not part of a slick process. We've taken our time to use our understanding of technology to bring this into our portal. So it's very slick, very seamless. You can choose your solicitor, and ultimately that puts you in more control to drive that deal through. You've got improved communication because you're the guys and your client are the people that are choosing the solicitor. And hopefully that means things are going to complete a lot more quickly because the relationship with the solicitor is all in your hands. One of those technology points is open banking. So we never ask a question. We only ever ask a question if we certainly do not know the answer. Now, we gather over 50,000 data points on a customer and the application, the property, the background portfolio. You know, all we ask for an application is a copy of the client's background portfolio and proof of deposit. We want to know where the deposit's coming from. Those are the only things you need to upload onto our portal. Now, in the early days, we tried to convince people to use open banking. We're actually paying them. We were paying about £250 cash back to use open banking. And at the time, take up was 9%. We took that away a couple of years ago, or about a year ago, and through awareness, word of mouth, improved systems, we're now up to 75% of our applications, our applicants are using open banking, which allows us to not go through and scroll through people's bank statements, but it gives us a snapshot of someone's financial position. So you don't need to upload bank statements, you don't need to upload mortgage history. This week, you may have seen in the press that we've opened an office in Scotland. Fleet have opened one in Cardiff. You know, from an operating cost point of view, it's very important for us to make sure that we're keeping costs down. But more importantly, there is an incredible talent base in Scotland that we've tapped into. We now have many more underwriters and case managers on board. And from that, we'll now be able to kind of confirm that from an SLA point of view, 88% of our cases are packaged and sent to valuation on the same day. Connells, bane of our life, they're turning around instruction to valuation in 9 days, and that's improving. We've got an average speed to offer from fee paid of 23 days. We aim to get from application received to formal offer in 14 days. With the valuers being slow, we're only at 40% at the moment. But ultimately, when we receive the valuation, we get from val received to formal offer in 2 days. So the journey's quick, the journey's slick, lots to talk to your brokers about, lots to talk to each other about in terms of educating and making sure that everyone's on top of those topics. I hope that's been informative.
Certainly was for me, Andy. Blimey. Okay, excellent. I did have a read of that last night, but it's always better when you've actually got someone actually like telling you and covering all the gaps. But that was brilliant. Thank you very much. We've got 2 questions, but one of them I could probably answer myself. But Marie has asked, does the landlord need to be a homeowner?
No. We need someone. There's a couple of answers to that. We need someone to have a footprint, a mortgage footprint in the UK. So someone who has a buy to let but is renting their own home or living with the parents or whatever it may be, that's okay with us. We do not assist first-time landlords, first-time buyers. So first-time landlords, yes, who have a mortgage. Landlords who have a buy-to-let but don't have their own resi, yes. First-time buyer, first-time landlord, no. Okay,
Steve Birkins asked a question, but basically, I'm almost certain you don't do consumer buy-to-let from my memory. No. It's not something you're in, so that wouldn't apply, Steve. But Steve might have a home for that. Maybe give me a call after 1 o'clock, and we can run through that particular inquiry. We are out of time, so I'm not going to ask the other 2 questions that you set yourself. There are no questions from the delegates. Mohammed, I'm going to come on to your question in my bit at the end, just so you're aware. I can cover that at that time. Andy, as always, thank you ever so much. Very, very informative. And from sort of like a high-level view of basically what's going on in the market, absolutely fabulous. I'm going to cover a little bit of this myself a little bit later with the way things are changing. But Andy, brilliant as always. Simon will remove you from the room. And I'll talk to you soon. Cheers, mate. Thank you.
Thanks, Tony.
Okay, right. We will crack on. It's slightly behind time. So our last speaker, here he is. We have Adam Butler from Avamore Capital. I'm hoping he is in the room. He was in the room. I just saw him a minute ago, but he's just disappeared. Oh, he's there. Adam, can you hear us?
I can hear you fine, Tony. How you doing?
Great. Yeah, really, really good. You need to catch me up some time if you would. So no pressure, but I will crack on. Everyone, you should have received this via email this morning. I'm hoping that is the same as the one that you sent me this morning. And I'm thinking, oh no, please don't change rates. It looks exactly the same, which is good. So that is current up-to-date criteria. None of our lenders today have actually changed their criteria this morning, which is good news. But I've seen another 3 have changed rates this morning. So a little bit about Adam. Started in the finance industry back in 2009 as a mortgage broker, largely based in the residential and buy-to-let sectors. He spent several years as a broker working for companies such as Countrywide and Mortgage Advice Bureau before changing roles to become a BDM at first for Bridging and Vida Home Loans, and then as a lending manager at Hampshire Trust Bank, which is where we first met, where he worked for 18 months. Adam moved to Avamore in 2019, first working as a senior relationship manager before moving at the beginning of this year to his current position as head of sales. Congratulations, Adam. His interesting fact, I had to change this last night because the first time he told us this, it was current Inter Milan and former Tottenham player, but obviously things have changed. He once played against Christian Eriksen, the former Inter Milan and current Man United midfielder, in a European youth tournament in Denmark. And we all know what happened. Yeah, obviously got mullered, I should imagine. Did you get anywhere near him?
No.
Absolutely nowhere near him. Yeah, all your pain. Over to you. I'm only hurrying because I'm actually bursting to go to the toilet. So over to you. I'll see you in 20 minutes, Adam.
No worries. Well, look, bridging's always synonymous with speed, so hopefully I'll catch you up and that will reflect our service on the bridging side. I just really wanted to firstly cover off a little bit about Avamore, maybe a company some of you may not have heard of. I remember nearly 3 years ago when I joined, an often response was, "Don't you mean Aldermore?" No, definitely Avamore. So Avamore as a company has been going just shy of 8 years now. We are a bridging and development lender, very much specialising in both. It's been the bridging side of things is what Tony would like us to focus on today. In terms of where we lend and us as a company, we very much focus on mainland England and Wales, not into Scotland, albeit that may be something for the future. But for now, very much focusing on England and Wales. As I say, we're just shy of our 8th birthday and actually just celebrating lending over £500 million. So that's literally been announced in the last week. Current live loan book is just over 226 million, but very much focusing, as I say, in more the development space in terms of our business split. In terms of our products, as I say, we do cover a range from bridging, refurbishment, conversions, ground up developments, and also part complete developments. As I say, we'll focus very much in the bridging space today. And a key thing as a non-bank lender is our funding line. So we've recently just come on board with a new funding line. We've had 2 in place since day one, so for nearly 8 years, and recently have brought one on about 6 months ago. So I think having a really broad and varied approach from our funding lines means that we can actually cover from the vanilla bridging right the way through to the more complex part complete developments. So that'd be pre-wind and watertight or more the sort of finish and exit that you may be more used to. In terms of, as I say, focusing today on the bridging side of things, very much where we sit is anything from an auction purchase, below market value transaction, whether that be a property that's nearing completion, just pre-PC, but also something that I think we'll touch on as well is that refurbishment products. I think that's something that people don't always know is available, and maybe think it's kind of full development or a bridge to purchase. There's a little split there you can see from our business split. As I say, very much bridging does make up a fairly decent part of our products, but I would always say that we are more focused in the development space, and there's probably often a development angle to our bridging proposition that we would do. I'll also cover a little bit about our process. I think we differ quite a lot to many in our space, in the bridging development space, in how we underwrite the deal and giving you that certainty. But a key figure I always like to highlight to people is the 75% formal HOTS, which is our heads of terms to completion. That really highlights our difference in our process, that when we look at a deal right up front, we give you that certainty, and maybe sometimes too honest for our own detriment, that others will lean in a little bit and things may change later on. But we really want to work with you and your customer and give you that honesty up front. Rising costs of fees, valuation fees, monitoring surveyors, solicitors, we want to make sure that if we are saying yes to a deal, that we will see that right the way through before your clients even spend any money. So just touching briefly on the process and how that differs for us. There's kind of two ways up front. You can have very much a quick indicative if you just need something quick to win with the client, or just to show the client what they can get. You can speak to us internally, or we do also have a new calculator online that can produce you terms as well. So please take the opportunity to have a look at that at some point. That can cover all of our products, but very much utilise it for the bridging space. But once you've got those indicatives, or if you actually have quite a lot of information about the deal, we can get it straight into credit committee at that stage. We have a one-page inquiry form. So the old days, from my term days of 30-page application forms and things like that, it's one page, very much basic information. We get that into our credit analysts, and they will do a lot of work in terms of the location, the client's background, the transaction, if there's any quirks to it. And we have credit committee every day. So within 24 hours, you can have credit back terms. And that's where I refer back to that formal heads of terms. That is what is issued at that stage. So before any legal work has been done, any reports have been issued, we are still converting 75% of deals that we issue there. So again, I think that shows the honesty that we give you up front, and the level of work that the analysts do at that stage. I think it's really important, especially in the market we're in the last sort of couple of years, and probably will do for the future as well. So that's very much how we differ, and then very much issue those heads of terms, get reports done, and move through the process. Now, I would point out I'm obviously focusing on bridging. The average turnaround time to completion is very much across all our products, and as you can see, the suite of what we do along with bridging with the development, that 6 weeks is an average across bridging and development. I wouldn't sit here and say we are a lender who can complete a bridge in 2-3 days. We will always need a valuation report done, but certainly within 2-3 weeks to fit within any auction turnaround time, that's absolutely achievable for us. On to a little bit about our product, as I say, focusing on the bridging space as well. So our rates at the moment, as Tony said, we have updated our suite, albeit not changed our products. What we have done now is how we advertise our product is it is linked to the Bank of England base rate. That is how we are funded, and the main reason we've done that is we, like many, I suppose, have been having to have some difficult conversations with people where rates are constantly changing. This way we can now fix our product. You know exactly what it will be, and it does track the Bank of England base rate up to completion, but on the day of completion it is fixed. So it is still a fixed rate. It's more of a how we advertise our rates, so that we don't necessarily have to have, and you don't have to have some difficult conversations with your clients as that Bank of England base rate continues to rise. Minimum loan size for us is $500,000. That is gross loan. So invariably most of the bridging and development deals we do is retained interest. So that is the gross loan of fees and interest as well. And looking at the other end of the scale, easily up to 10 to 15 million on that side, albeit that's probably more in the development space than we do 10, 50 million pound bridging loans. So as I say, rates at the moment is 0.69% per month, plus Bank of England base rate, obviously currently as we speak 1.75. We do both residential and commercial bridging, up to 75% gross on residential and 65% on commercial. We can also look at mixed use, and we are at a 50-50 split in terms of the residential commercial units, and that's on square footage and value. So again, where others may still be at the 60-40, we can consider on those as well. I'll touch a little bit more on the refurb angle to bridging a little bit later, but actually even just on our straight vanilla bridging product, we can consider up to 10% of works and fund that as of day one with no QS, MS going out, and no reports need to be paid from that point of view as well. But I would say, as I mentioned right at the start, very much in the bridging space, where I think we do most of our deals is where there is a potential development angle. Talk a lot about turnaround times at auction purchases, but from what I've seen in the last 12, 18, maybe even 24 months, is that actually the wider market almost feels like an auction at the moment, with vendors setting pretty restrictive turnaround times. There's a lot of people out there, a lot of cash buyers that then puts pressure on people who do need to take a bridge or a loan, 2-3 week turnaround times. Where we can look to do it is, let's say it's a commercial asset where there is a development angle or a conversion angle. Put them onto a commercial bridge to get it purchased within that sort of 2-3 week deadline, but then convert them onto a development product, conversion product once they've got the planning or the PD in place. And what we would do is we would only charge any additional fees on the uplifted borrowing. So we wouldn't effectively double bubble on the arrangement fee or any exit fees that may come later on down the line on the development product. So that's very much where we see a lot of the bridging space. That obviously doesn't have to just be a commercial property. It could be a residential asset where they're going to be knocking it down and rebuilding. Again, that's the sort of angle where there's a development space. There's obviously a lot of lenders in the bridging space who solely focus on bridging. I think where we stand out is, as I say, is in that development angle. And I hate to say the term speed because everyone says that on bridging. But yeah, as I say, if there's a development angle, that's very much where we would stand out, saving your clients the double bubble on fees. And that's not just our fees, but solicitors' costs, any valuations. You can just get a retop if it's over 6 months. Solicitors using the same solicitors we did to do the acquisition. In terms of backgrounds of clients, again, we're pretty flexible. It is very much property-based lending. Bridging, we very much look at the asset and the exit. That's the key focus for us. So clients with adverse credit, we're absolutely fine with that. So the only thing we wouldn't like to lend to do is probably anyone who is in live insolvency. But again, foreign nationals, overseas, expats, anything like that we can consider as well. And again, looking forward into that development space, if you have someone where I think a lot more people are moving into that development space, need a bridge to purchase, we're also probably one of the most flexible on previous experience for that developer. So again, the right lender to get that bridge initially to then move them on to a development space, someone who's looking to grow their development portfolio. And again, talked about it before, but anywhere in England and Wales, we're able to lend. I also mentioned briefly, albeit I haven't got a slide on it, I think just touching on the refurbishment area. I think there's quite often when I speak to a lot of brokers and clients, especially, I think they kind of think there's two products out there. There's development funding and there's bridging funding. And actually in that middle ground, really, there is this refurbishment product. It very much, I think, is more in the bridging space when you talk about lighter works. For us, we can consider anything from 10% worth of works right the way up to 150% of the purchase price, a real heavy refurbishment. But I think looking at that more bridging side of the refurbishment area, up to sort of 50% cost of works versus the purchase price or the current value, we can still do 75% net plus fees day one and fund the full build facility. And this is something actually I think we come up against where there's other bridgings that may be able to go to 80, 85. When you look at how that is funded, for me, that is still kind of a bridge in that space. We will fund the 75% day one, but also fund the full works. And obviously the interest is only charged on the works once you draw it. So actually essentially give the client more net funds, but also actually cost them slightly less on the interest rather than being charged right from day one. So again, always consider, I know obviously Tony and his team fully aware of that. So if you ever have any in that refurbishment space where actually there is a amount of works that needs to be funded, and certainly if those works are below 200,000, we would look to do that with no QS and no MS. There's no additional survey fees if we do fund the works up to 200,000 as well. A couple of examples, I think, in terms of the sort of thing we have done before, as I say, very much looking at getting someone on a bridge. This was actually a development exit. Current lender was at end of term, so needed to turn this around very quickly. A large scheme across 3 separate sites. We were able to turn that around very quickly to meet the exit deadlines of the current lender. As you can see there, from inquiry to credit back terms, which was ready to fund basically for us, was in 11 days. So even though we did still need to get a full valuation done on that, we were still able to turn that around very, very quickly. So again, those sort of things we can look at, maybe the larger schemes or where there's potential development exit, we can also consider as well. And just for pricing, again, I know very much focus for today's talk was on the bridging, but you can see our wider product range there. As I say, I think that refurbishment is very much where we probably do more in the bridging space, so to speak. We can consider that right the way up to 75% against both the purchase price and the GDV. And in the bridging space, as I say, up to 75% on refurbished on residential, but up to 65% on commercial. And very much, although the products are linked to Bank of England base rate in the bridging and refurbishment, they are fixed on completion. It's the development space and the part complete development where we actually are now offering a floating rate, which tracks SONIA, the 1 month SONIA rate as well. But there is also fixed rates available on request. That is everything from me. So hopefully I've caught you up a little bit, Tony.
Perfect timing, absolutely perfect. Adam, absolute superstar. Like you say, bridging is always quick, and obviously Avamore's one of the quickest, which is great. Thank you for that. Very, very informative. We don't have any questions from the delegates, so over to the ones that you asked, you actually set yourself. Why would we use Avamore for bridging over other bridging lenders?
I think you sort of touched on it there. I think very much where, because we are a development specialist as well in the bridging space, I think it's where there is a potential development angle. You know, having to take your client to get a bridge to purchase, all the costs associated with a new application, a new purchase, and then potentially moving them from that lender to a development lender, twice as much costs. You know, I think that's really where we stand out in the bridging spaces, where there's a potential development angle, whether that be, it could be anything from an internal refit to a conversion of office space, retail space to residential, or even, as I say, a complete knockdown and rebuild. That's where we would really stand out and saving them the costs at the next stage. Okay, and the second one you set yourself was, are there other products that could be beneficial to someone looking to take a bridge? Again, I've kind of already answered my own questions, haven't I, a bit. I think for me, I think it is that refurb product. I think, you know, as I say, there's a lot of bridging out there that may be at 80, 85, and they're getting that all day one. That looks very attractive, but I think it's just not for getting that refurbishment space where you've got 50 grand, 100 grand, 200 grand, anything in that sort of space. I think where what I would call light refurbishment, or even potential conversion, you know, a single dwelling into 2 flats. That's something we're seeing more and more. I think, as I say, it's not forgetting that refurbishment product is available and actually how it can potentially offer your clients more net funds, and actually potentially cost them less for it in the way that the interest is only charged once the bill facility is drawn. Okay, Adam, great as always. It's not one of our first time speakers, Adam. He's done this quite a few times. Always great, always very, very passionate about what he does. I'll tell you one thing, he's bloody good at what he does as well. So, Adam, I'm going on holiday next week, but I need to see you the week after if you're around. So maybe we can talk a little bit later if that's possible. Terrific. Okay. Simon will take you out the room. Thanks once again. And a little bit about what we do. But always, I have this, well, for the past few months, since obviously there's been all the changes, I've been starting with what's happened in the last month. I changed this slide this morning, the next slide this morning, purely because there's some stuff I read on the NACFB, and there's a couple of bits I read last week as well. But now that we have a new Prime Minister, there's talk about these three being merged. Whether that's going to do us any good whatsoever, it will mean reduced staffing across the three if that happens. Whether that means reduced costs, well, of course it won't. We'll probably be paying more in some way because it's because of the way these things are done. But that could be very interesting. Whether that's going to do us any good, I've seen a few commentators saying. One commentator, I saw Vince Cable, said that if it's not broke, don't fix it. Well, he's obviously not had any dealings with the FCA in the past few years, because in my opinion, they are very, very broke, still allowing the same amount of mis-selling scandals to go on, completely under their watch, as they always do, because unfortunately they seem to employ people who've got no financial service experience whatsoever. So how would they realise that something's going to go wrong if they've not got the experience to actually see it in the first place? But that could be interesting over the next few months. But I'm quite keen to see what will actually happen with that. In the coming months. Let's wait and see. I mentioned this last month. We have an exclusive with Castle Trust Bank, which is a heavy refurbishment deal. Was actually initially offered as a heavy refurbishment deal, but the main thing I've put 2 bits in red on this slide. Maximum LTV of 90% of current market value. Now I know one of you, because I know you're attending today. You sent us over a deal yesterday. This is the product for that particular deal, and because this was, like I say, originally launched as a heavy refurb, but they will also look at deals where, for example, on that development that you put to us yesterday, that is almost at practical completion, they will look at this deal at 90%, as long as the GDV does not exceed 75%, which on the figures I saw, it doesn't. So I won't give your name, but you'll know the deal, because I know you're listening. So give Sakina a call, you spoke to yesterday. Let's get that one moving, because we've only got a certain amount of funds on this one, and when it's gone, it's gone. But this is proven to be very, very popular.
and we've got a calculator on this. Clients could be receiving up to almost 85% net of the property value after interest and lender fees. Great little product, but it's not available indefinitely. So if you've got anything on your desk at the moment that covers any type of bridging at all, then you know where we are. Okay, so also I want your help, everyone. So if you can sort of get your keyboard at the ready, because I've been asked to write an article for a lender, and basically what do we want from lenders at the moment. Andy Virgo touched on obviously some of the problems lenders are having at the moment. From a broker perspective, I mean, while some of the speakers have been talking, I've just had a look at some of my emails, and this is where it really causes me a problem. I mean, I've got their better training for lender underwriters. Last day of the month, we were asked by a lender underwriter on the case that was completing that day, why the address that was on the KFI was showing a different owner. She'd never seen a KFI before, never, and she'd actually done a land registry search on the broker's address, and she thought that was the security address for the exit. So better training for lender underwriters is something I want to see. Better office-based support for new lender underwriters. Too many of them are working from home, are being left to drown, in my opinion. So I think that we do need a return to office-based for many people, especially new people into businesses. And this one, ensure interest rate deadlines are not shorter than turnaround times. We've had a lender this morning has changed their interest rates from Monday, and has given us 10 days to get cases that have previously. So if we put a case to them today, we've got 10 days, we've got 12 days from today to get that to offer. They currently have a turnaround time of 8 days. So if we send them in all the paperwork and they come up with one stupid question, which is totally irrelevant, such as recently they asked us for a repayment schedule on a director's loan account, that means that deal will not actually go to offer. The rate has to be increased. Now that's one of our problems. But I'm really looking for anybody, any of you, to give me some ideas of the stuff you're seeing. That's why it's got the anything else, which unfortunately has bled into our logo. But anything else that you can give me as far as ideas, and I will put it in this article, because this is not so much a cry for help, but at the moment we realise what's going on in the marketplace. Some lenders, and not all lenders, most lenders are actually doing it properly. Some lenders aren't helping themselves. We had a lender yesterday who said, sorry, you're going to have to increase the rate on this deal, but they've got a turnaround time of 15 days. They're changing their rates every week. It's just, it's proven to be impossible. At the front end, on the residential side, my staff are tearing their hair out, as are many of you, with what's going on. Because some deals, I mean, we've got one deal with Barclays at the moment. We've been trying to get them to agree that the stupidest thing you would ever come across as far as getting a deal offered, and that's been since the beginning of August. So really, just your ideas. A couple of you have just mentioned a couple of bits. Just any ideas that you can give me where you're experiencing problems with lenders and what they are doing. Okay, your help will be greatly appreciated. So a little bit of information about us and what we can do for you. I am just about on schedule, thankfully, so I won't have to rush through this, but I'll try and finish before the scheduled time today. But this is really about what we can do. If you haven't heard of us before, a lot of you use us for business that I've seen that are attending today, but there's also a lot of new names that I've never ever seen before. So you're obviously new to these shows, I would presume. So this is just a little bit about us, because you probably never heard of us, because we don't plaster ourselves. We don't do awards dues and all that sort of nonsense, which we'll come on to in a little while. But this is just something about us. We see it as a partnership. Now, you're all, hopefully, most of you will probably be FCA regulated. So you are in partnership probably with some packages. You probably deal direct with a load of lenders, but there'll be certain products that you can't offer. You might not, for example, be active in the second charge market because it's a very closed market as far as agencies are concerned. But we see it as a partnership. So we're in partnership with you to help you, your clients, get that deal over the line. That's what we're here for. Don't see it as a master broker, introducer type situation. We are in partnership. I haven't got a business without you, and potentially you can't complete that deal without me. I want to help you grow your business in any way possible. We're now developing some marketing ideas so that our broker partners can contact their databases with various marketing pieces that would then enable them to reach those clients who've maybe got an EPC of DRE. And I know that the rates are the rules are changing at the beginning of 2025. When you think we are closer to the beginning of 2025 than we are to the beginning of lockdown, the first lockdown in March 2020, time does fly. Believe me. And before we know it, it's going to be the end of 2024 and clients are going to be going, oh, hang on a minute, my EPC's not good enough. I can't rent my property out to any new tenants. So we want to help you grow your business. Doesn't matter what your FCA status is. The majority of our broker partners are directly authorized. We've got a hell of a lot of appointed representatives. My third biggest business partner of all time, since we started trading, is an appointed representative of a major network. He refuses to use the companies that are suggested to him because they are, in his words, absolutely bloody awful. So it doesn't. If you're an appointed rep, we do not have a problem with you placing business with us. Exempt professionals, also no problem. Not authorized, not a problem. Unless, and this is a situation we had after last month's show, we had somebody apply to us, sent us in an agency application and 3 regulated mortgages. We then did our due diligence on him, not authorized by the FCA, plastered all over social media as giving mortgage advice. So I refused him and was then accused of being racist, which I took offence to massively, because I'm not prepared to take on the responsibility of somebody deciding to break the rules when the whole of FCA decide to take action. It will be against me and my company, and probably very little against him. He'll just disappear somewhere. So we do have solutions for if you're not authorised, but if you're over social media advertising your products, advertising products as giving advice on regulated products, then it's not something that I can entertain. I want to make sure you stay informed and compliant, hence GDPR things, and hence EPC situations. It's something we do continually. So we want to make sure you're writing business indefinitely. When you think we get most of our updates, it seems, from the financial press, who most of the time just aren't fit for purpose because they don't know what they're talking about. Our industry is very poorly informed at times, very, very poorly informed. Really, probably, I mean, some of the trade bodies that we're all most of us are probably members of, need to do that little bit more over what's going on. Okay, our products, pretty much everything other than we don't do equity release. So, and we don't get equity release business for that reason. So if any of you don't contact me saying, I'll do your equity release, we don't get leads for equity release, but we cover everything else. This is our specialities. And we just happen to be very, very good at it. So that's our products. And it doesn't matter. Our service is packaged or introduced only. You can mix and match. You could, for example, we have broker partners who give us deals where we package, they give the advice, but when they take their month holiday each year, they ask us to then take on the advice process. When they return, the new business will then go back to the way it was before. We can mix and match as long as you've got the permissions to give the advice. That's all I'm interested in. You choose how you want to put business with us. Entirely up to you. It's not one or the other. And why are we different? Not the products we offer, because we offer the same pretty much as everybody else, occasional exclusive, like you saw previously. The people we employ, absolutely vital. I will not employ people just out of school, just out of university. I want people with a minimum 5 years specialist financial service experience, and not 5 years working behind the counter at Nationwide. That's why I have when I advertise. That's what I'm looking for. We have staff that are multilingual. I'm not going to try and pronounce the first 5 because I always get them wrong. I can pronounce the 6th one because I was born in Edgware. We've got staff member who has a smattering of Hebrew, which comes in incredibly useful for certain occasions, such as when we get payslips from Israel, which are in Hebrew. Mature life experience. There's a reason why that's highlighted. That's something that money cannot buy. It really is that maturity that whereby. So when on the rare occasion that things do go wrong, and believe me, we're not perfect, and sometimes do go wrong, my staff have got the ability and the knowledge and also the experience, not only to recognise, oh, hang on, that's gone wrong, but also how to deal with it. And it's very, very rare that I have to get involved in any case that a member of my staff has where things have gone wrong and they can't deal with it properly, or with a broker partner. Occasionally things do happen. The biggest problem we have at the moment, obviously, is lender turnaround times and the expectations of some of our broker partners that if we instruct a valuation, it's not going to be done the same day. There is actually, with some valuers, there is something of a waiting list, and we might be waiting 3 weeks, not 3 hours. So it's an understanding that things are tough at the moment. Things are incredibly busy. We're currently running over capacity, but we're managing to keep on top of everything. But I know some of my competitors are absolutely floundering because they cannot deal with what's coming in at the moment. So mature life experience, the most important thing I look for in any member of staff. And all of my staff are in their 30s, 40s. Most have got children. And if they can deal with children, they can deal with the naughty children, they can deal with clients. So that's the way I look at it. So, but that's why we are different. It's the other reason why we're different is our lender relationships. I've been doing this now, 20th September 1983. I started in specialist finance, 39 years in 12 days' time. I've grown up with a lot of the people in this industry who, when I started, were BDMs, underwriters, and they're now at board level with lenders. Let's say well over half the lenders we deal with, I will know somebody who's at a very, very senior level. And that can come in at times. That comes as a massive advantage to us, because I'm not speaking to the underwriters, I'm speaking to the decision makers. And we all know when I was an underwriter many years ago for a lender, I could take deals to my managing director and I could actually convince him whether he should do that deal or not, purely sometimes because of the broker that actually placed a business with us. And so that is one of the biggest selling points I can probably give it, is our lender relationships. Absolutely massive. And because I still get involved in cases, I can help steer those cases over the line. We take our compliance very, very seriously. We have now had our third NACFB compliance report, which came back. We passed it with flying colours. The only thing they said we should have was that our privacy notice should make reference, our terms of business document should make reference to our privacy notice. That was the only thing they came up with. That was it. It's how seriously we take the prevention of financial crime. We do catch people. And when we do catch people, we take it through the proper channels just to make sure there's no comeback on us or our broker partner. And it's not our numerous awards from the financial press. We will never, ever win an award for best broker or best packager, only because A, I would never put myself forward because it's corrupt. And B, I don't want one. I don't need one. I haven't got the ego the size of Luxembourg that means that I have to win 4 or 5 awards, because this is how corrupt it is. Not saying so much in the lender space, because we all vote for lenders. When it comes to brokers, are their customers voting for them? Or in this situation, was it all this guy's Facebook friends? And win a £250, one lucky winner will get a £250 Amazon voucher for voting for us for an award where you've never taken a loan or finance through us, but just vote for us anyway. And wins regularly. And is all over social media about they won something. And you speak to their staff and their customers, really not the case at all. This was a recent awards that I was on holiday at the end of June. My wife wasn't very well, so I had some time on my hands because we couldn't go very far. So I thought I'd go on the internet and saw that this was announced. I'm not going to say who the publication was, and as it says there, I'm not alleging any wrongdoing has taken place. I'll let you make up your own mind. Main sponsor was HSBC, and these were the winners. There you go. I think there was 20 from memory, so 20 winners of awards in various categories. And these were the sponsors and the regular advertisers. 15 to 75% of the winners were either sponsored or were advertising on a regular basis. Make up your own mind. The 2 main awards, now of course for any lender, HSBC sponsored 2 categories, Best Surveyor, Best Network, and Central Trust sponsored Best Second Charge Broker. The main award that any lender wants to win is Best Mortgage Lender. And guess what? HSBC won Best Mortgage Lender and also BDM of the Year as well. And Central Trust, who was sponsoring the Second Charge Broker Award, that went to the Loans Engine, who are a subsidiary of Central Trust. Make up your own mind. What else can we offer? Designated underwriters from start to finish, except now one thing we've added, and Andy Virgo alluded to this in his presentation, how important it is that once a deal gets offered, that's not the end of our involvement. We've always done this, but I've now got a dedicated person on this every single day, just ensuring that the solicitors are doing their job properly and not stretching the deal out as long as possible, just so they can add a bit more on the fee or a lot more on the fees. So that is something we're now doing. So we are all over these solicitors like a rash, making sure they're doing their job properly, and also the lenders to make sure they're doing their job properly as well. Because that for me, once a case is offered, that is the most difficult time. Other than surveyors and trying to get this, I mean, we've all been through the battle of getting the property surveyed and getting the figure back and then getting the lender to get it offered. And then we're waiting weeks, sometimes months for solicitors. Well, it doesn't happen with us because we are all over these cases like a rash. The only other time someone gets involved is on the day of completion, because that's when I pay you, as long as we've got your bank details. And as long as we've got confirmation from the solicitors, it's completed and not from the lender. Too many lenders say deal's completed, and we find out 4 days later that the transaction actually fell through because the chain collapsed, for example, and the solicitors returned the funds to the lenders. So, but we pay immediately. We find out from the solicitors, or in the case of a second charge, that's when we are advised by the lenders because they have their own in-house legal teams. We pay you straight away. No excuses, unless we don't have your bank details. No excuses. And there's numerous times I paid broker partners over the years, such as when I renewed my wedding vows, and the day I renewed my wedding vows, the day of my daughter's wedding, and more recently last year when I was in hospital and I just had a shoulder operation. Still paid our broker partners on the day of completion, and no commission clawbacks unless it's fraud or unless the client cancels basically cancels the transaction within a 14-day period that some lenders allow. So, but that is guaranteed. All our inquiries are pre-qualified, and there's a very good reason for doing this. We all know what it's like with some clients sometimes. When you ask them the question, do you have any problems? And they say, no, nothing at all. Well, it turns out they do have problems. Worst we ever saw was a guy with 12.5 million quid CCJ 3 months prior to the application, which he forgot about. You think he might have remembered, but because we do second charges, we have access to Experian and Equifax directly. So it means that we can get that search done once we've got the client's authority to do so. We can get that search done right at the outset, and we will know what the route that we should go down. We're not going to be hitting any dead ends because of what's coming up on the credit search. We know immediately what direction we should be going in. And because if we know which lender we're going to, sometimes the information on Equifax will differ to the information on Experian. So that can also play a big part in where we place a case. So one of the things we do right from the outset, as I say again, I'll say it again, is we get a search done. Our own expense, and it's a soft search, doesn't affect their credit rating. So, and that saves us time like you wouldn't believe. I know some of you will probably get stuff from the client. That doesn't show the client's credit score that the lender will take on board, because Equifax, for example, have 4 different types of credit score. And some lenders use different ones to others. So we will know which one to actually use right from the outset. Other stuff we can offer, and this has proved invaluable over the last few months with all the changes that have been going on with lenders. It's so difficult to keep up to date with. Last Friday, I sat down with one of my staff. We were going to look at a client who's looking to basically their entire portfolio, wanted to refinance their entire portfolio. So there were some issues with the case, with their circumstances, quite a lot of buy-to-lets, that kind of a lot of lenders, and other situations as well. So we sat down with a list of lenders that we were going to approach, and by the time we'd finished, 11 lenders had changed their rates. 11 out of the ones that we were looking at, and that was over half of the lenders that we were looking at. So we introduced these quite some time ago. Loan quote was 2016, commercial quote I believe was 2014, and bridge quote about 2017. These are kept up to date as and when. So as an example, yesterday morning, Capital Home Loans and Together changed rates on some products. That was around 10 o'clock. They launched them at 10 o'clock. By 10:15, our sourcing system, our commercial quote system, was up to date with those changes. I'm still looking at Mortgage Brain at the moment, and it's showing rates from the previous time that the lender changed their rates, because they can't keep up to date. And the lenders who keep these up to date aren't able to keep them up to date. So this has proved invaluable for us. And the other thing we've got on that is that so many lenders don't appear on Mortgage Brain, Trigold, and 27 Tech that we have on our system, because it's a specialist finance system. So it's for those non-vanilla cases that you're thinking, where do I go with this? Well, we can tell you within 45 to 60 seconds, quite literally. Data security, no one's getting in our system, so my IT department tells me, and so do the penetration test providers. That's IT penetration test providers have told us that our system is in the top 5% in the country. Much better and much more secure than many large companies. And I can think of one lender, if I wanted to, I could actually get into their system now and get their entire client database. That's how poor their security is. And that's a large lender. Our second charge panel, available either on an advised or non-advised basis. And Mohammed, this actually comes around to the question you asked earlier on about packaging. So this is one of the answers I'm going to be giving you. So we deal with the whole of market on second charges. I know personally the people at the top of every single lender on our panel, every single one, which again just makes our job so much easier when there is that case that is borderline, and I can speak to somebody and give them the warts and all scenario, and more often than not we get it over the line. So that's our second charge panel. I would just be very careful. Now, I've included 2 slides here. This is the L&G Mortgage Club second charge panel. That I took this, I think it was on the 3rd of August that I added this slide. They still had Masthaven, who stopped lending earlier on this year. They had Precise, who I think had withdrawn a few days previously. So really all they had is Shawbrook and UTB, and that's it. That was their panel. This was Simply Biz's panel. Central Trust, yeah, still lending. Masthaven already withdrawn. Paragon stopped lending last year on second charges. So why is that still on there? So they've got Precise, stopped lending. So what they got Shawbrook and UTB. We've got I believe it's 16, 17 lenders that we will look at on every case that comes in. So if you are using one of the Simply Biz or L&G panel, and that's all you're using, you really are probably doing your clients a bit of a disservice, because you're not looking at the whole of market. And it's, if you call yourself independent on anything at all, you really do have to have a little bit more than just Shawbrook or UTB, because there's some lenders out there at the moment who are offering some great products. I mean, Shawbrook and UTB, both great lenders. We use them all the time, tremendous lenders, but they're not right in every circumstance. I did see something on the Cherry Foreman a while back. Some guy said, if he gets a second charge in, he'll always just bung it over to Precise. Precise at the time were 2.5% dearer than their competitors for the same type of deal. Our package regulated first charge panel, that is basically what we have at the moment. So if it's regulated deals, please don't give us deals for Halifax if you have a Halifax agency, because it's only 60 grand and you can't be bothered to do it. There's no money in it for us. There's no money in it for you. But certainly any of these we can package on your behalf. And with the family, for example, we do have semi-exclusive products, which again, we can send you details of those should you wish, with the full current product panel, because they've just actually returned to lending back on Monday. But that's our packaged regulated panel. Our specialist buy-to-let panel. As you can see, there is a lot more lenders, but these are the ones we offer to broker partners where there's no point us putting Virgin Money and BM Solutions on there, for example, because you probably do them yourselves. But there'll probably be some on there that you haven't got access to, and probably some on there you've never even heard of. And there's deals that some of those will do. And there was one yesterday, one of my staff said, we got this deal just come in. It's a consumer buy-to-let for somebody who's an expat. Said, okay, Lenco will do that. And we placed it with Lenco, and guess what? They've agreed it. The introducer had actually been through several lenders and been turned down for that and didn't know where to go. We knew straight away. So that's if we're giving the advice. If you want to give the advice, all of these, quite simply. That's the panel where you can basically give the advice to the client, and we just do the back office part, but we also help you with the sourcing. That's the major part, is helping you make sure that deal goes down in the right direction right from day one. And Mohammed, this probably covers the first part of your question. So if you want to looking to use any of these lenders and looking to use us as a packager, we do not charge a packaging fee up front or on completion. So you've got 9 lenders there, family all the way down to West One. So that's those lenders. For the other lenders, we wouldn't normally charge any more than 395, depending on the size of the deal. If it's a £2 million deal and we stand to earn 15 grand each out of it, am I worried about a £395 packaging fee? Absolutely not. If it's a 100 grand deal, we probably charge it. But that's our 0% fee package panel. And just a little comparison to the others. Now, this was taken from Mortgage Brain and Trigold, I believe, a little while back. As you can see, our competition charges anything between 95 to 299 quid. And those are up front, whether the deal goes ahead or not. We don't charge a thing for those 9 lenders. Our bridging panel, we have packager status with pretty much everybody that we deal with. I've just realised I haven't got Avamore on there, which is very, very poor of me, because I did update this last night. I will put them on for the next time. But with the majority of almost all of those lenders you see there, we have packager status. So it basically means we can pay you the same as if you went directly. So you'd earn exactly the same, and also build in any fees you wish to charge as well. And the reason why, one of the reasons we're able to do that is that we're able to source all our bridging inquiries on day one. One of the very, very few brokers or packagers who have the ability to actually source bridging and work out what the best deal for the customer is, and also what deal is actually going to go through. Our commercial panel, that's pretty much everybody you can see that's on basically everyone that's out there at the moment. The high street, as you would normally expect, plus a lot of specialist lenders who you probably never even heard of before. If you want to advise on second charges, again, Mohammed, this is also for you. So you want to advise on second charges. I mean, what we heard from Marie today and how important second charges are going to be in the coming months and probably couple of years and ongoing. Quite simply, we have access to every lender in the marketplace. We can help you source the best deal for the client because our sourcing software actually works. We have seen one of the three sourcing engines, their second charge offering is abysmal. At one stage, it was only offering 40% of the products in the marketplace. Of course, and they only offered those lenders that actually subscribe to them and pay them money, of course. Always remember that. So we help you source. We help you with file compliance. We instruct the surveys and issue consent to second on if the first mortgagee has a restriction at land registry. That might not be something that you're familiar with. We do all that on your behalf. We package the case, check all the documentation, submit to lender, pay you the income on the day of completion, no loss of control, and Mohammed, no packager fees. Doesn't matter if it's 10 grand, no packager fees. For us, it's the way forward. We don't offer that on regulated first charge mortgages. I will just say that again. So please, we always normally get after a show, we normally get half a dozen applications come over from somebody that they've not been able to place, and they are normally, as you can imagine, fairly poor in quality. So, but for second charges, if you want to give the advice and you've got the permissions to give the advice, we can accept business from you and help you get those cases through. If you want to charge £5 grand fee on completion, you can do. If you want to charge 395, you can do. It fits your business model. That's what it's there for. Commission and prop fees, we brought this out, I believe it was earlier on this year. If you want to see our current commission and prop fees, highly competitive, only because I've seen what our competition offer. So where we can offer you more, we do. Some lenders actually restrict what we can pay away so that everyone's on a level playing field, but where we can offer more, we will do so. Just enter the word PROC in the typing message at the bottom, and we'll get a copy over to you today. But that's now run into, I believe, about 12, 13 pages of lenders. So it covers a large number of lenders and what we're able to do. And beware of the bandits out there, please. This is a slide that I took out some months ago, but I brought it back after speaking to a broker partner who completed a case I'm going to be talking about in a moment, because he first completed it with another broker back in 2019, titled applicants, a lord and lady, £7 million case, and he was paid £7,000 because he was told that it was half the prop fee that was paid to that particular master broker. They lied massively, as you can see, 117 grand. That brokerage earned and paid him 7. When I told him what they actually earned, he threatened to sue because he'd been lied to, but he couldn't prove, because it was on a telephone call to his mobile, and he couldn't prove that prove the conversation basically. But absolutely horrendous. 110,000 profit from a deal and paid that broker 7 grand. Disgraceful. That had come to us, that would have been whatever what is that, 58.5 grand with my limited maths on the day of completion as well. So there you go. Just beware, just make sure you're being paid what you do and you're not being spun. And we've seen loads of these over the years where introducers are basically spun a web of lies by master brokers. Just be very, very careful. A couple of case studies for you. This is a YBS case completed earlier on this year. I won't go through the whole thing, but I mean, it was one of those that had a company structure that was very complicated. I know Gaynor said they don't accept anything offshore. Well, it was originally ultimate beneficiary was based in Panama. There were some changes made to it to get it through, but it was an incredibly tough deal. 3.35%, introduced a partner, earned £12,187 on the day of completion. So that was one. This was a Roma Finance case that we completed last year, and we're just now doing the exit, which is for 2.15 million, still for 2.15 million. 20-bed property that had permission for a 10-bed HMO. It's now got permission as a 22-bed HMO, and I think 3, 4, 5 of the rooms are about 9 square meters. It's absolutely tiny. But there was various issues on this, including the neighbouring property stealing their electric from the property for many, many years. So a lot of things to overcome. Introduced a partner and 21 grand from that case on the day of completion. And this was one we completed on the 5th of July, the most difficult case I've ever been involved with in the entire time I've been in specialist finance, which is a long time. This was incredibly difficult. 19 properties. and a property manager that was basically helping the clients, who was also a director of the company. The other two applicants lived abroad in Israel and had lived abroad for over 20 years. Unfortunately, whenever we asked for something on each, so for example, when we asked for tenancy agreement, the ASTs on the 19 properties, we would receive one. And then a week later, we get a phone call. What's going on? We're still waiting on the other 18. Oh, right. And then we get another one. And that was the way. Then we get, for example, we get pages of the AST that were irrelevant. We wouldn't actually get the pages that we needed. And the same on the insurance. We were being sent demands and needs statements rather than the actual policy. It was incredibly difficult. But managed to get this through. We had to switch the deal halfway through to Castle Trust because we needed dual representation to get rid of a solicitor who, I don't want to describe what I actually thought of him, but he was probably the worst solicitor I've ever come across. So we managed to switch it to Castle Trust, got dual representation and also title insurance, which proved absolutely invaluable. But other problems, including 5 charges that should have been that were repaid 18 years ago, but had never been removed. 2 of those lenders have stopped trading. Try and get those removed. Absolutely horrendous. We managed to get it through, and the introduced apartment at 45 grand. Again, that wasn't quite the day of completion. We had to pay that in 2 lots because we've got a cap on the amount we can pay out each day, just in case if we ever get hacked. But 45 grand. But that one, when it completed, I did actually not only chat out in the office, but also had a drink that night as well. Believe me, a real tough one. But we got it through, and it took a while. And this was what our broker partner said on Trustpilot. If I could give more than 5 stars, I would. I'm not going to read all the rest because it's too long. We've only got 10 minutes left. Tony and Joe, which is very nice, had the patience, experience, and depth of knowledge to complete this very large project. I've introduced many more cases to Specialist Hub, additionally dealing with Hayley, Kirsty, and Sakina, and I found them all responsive, dedicated to success, and fun to speak with. This particular guy, semi-retired, he said to me, "I wish I found you 20 years ago. I could have made a fortune." His words. And now he said he's earning more in semi-retirement than he was when he was in full-time financial services. So we're doing something right. And this was the other case that we completed in July, which was helped us to get our best month ever. The Lord and Lady that I mentioned previously, their deal expired, and we helped to refinance it. 18 properties all in the same village, and most of you know what it's like trying to get cases where they're all grouped next door to each other or all in a very, very tight location, because of obviously lenders do not like that type of situation. First came to us in the middle of lockdown, try and get a deal through for someone who at the time was 85 and 81 during the coronavirus outbreak was incredibly tough. This was the second most difficult case I ever dealt with. Introduced a partner, 30 grand on the day of completion. Recently took me out for a slap up lunch and plied me with booze as a thank you, because that was his biggest payday of the year so far. And it's a deal that he really didn't get involved in. And it's not what you know, it's who you know. This was a husband and wife business, 2 very profitable children's nurseries. Mr. run the financial side, Mrs. run the looking after the kids side. Mr. had defrauded HMRC of 850 grand over many years, was caught and sentenced to 5 years in prison. She divorced him. Every asset that was in joint names had a Proceeds of Crime Act charge put against it. Barclays only had charges over the 2 commercial properties, and they immediately called in both mortgages. So she was in dire straits. Her mortgage on their resi had also expired. There was a Proceeds of Crime Act charge on that. Been to multiple lenders, all declined because of reputational risk, because they didn't want to go anywhere near a deal with Proceeds of Crime Act charges. But it wasn't something that was down to her. She wasn't charged. It wasn't down to, it was down to him and what he'd spent the money on, which was absolutely disgraceful as well. So she's about to lose everything. So we received a deal. We contacted Together Money. Had already been contacted previously by other brokers as well, but had only contacted at underwriter level. Had gone to the compliance department. Of course, the compliance department needs to be seen to be doing something and actually be noticed. So, of course, they declined it. Case was handed to me to sign off as a decline. I thought there's a deal to be done here. Absolutely. I mean, 300 grand sitting in the business and 55% LTV. I can't remember the exact figure now. 10-minute conversation with somebody I know at Together at director level. I've known for many, many, many years. Told him the case, and he said, "Why aren't we doing that?" I said, "I don't know." 10 minutes later, he's gone to the compliance department. It's always a little bit different when a director goes to a compliance department than an underwriter. And guess what? They changed their mind. The deal went through. She kept all the properties, had Mr. removed from the titles on all the properties, got rid of the proceeds of Crime Act charges, and now all those are back with the high street. So together it's been paid off on all deals. She's back now with Lloyd's on our commercial properties, and we arranged her resi mortgage as well. And that was all about one phone call, where other brokers weren't able to do that because A, they probably didn't have the contacts, and B, probably didn't have the knowledge to actually do something with that deal. And a little bit, that broker basically said, service you and your team can provide and continue to provide is second to none and well beating. He did also offer to take the entire company out to lunch, but we had to turn him down on that, otherwise we'd have no staff in. But that's the sort of feedback we're getting on our cases. So any cases you can't place, or any cases where you're currently thinking of placing somewhere with somebody else, but you want to give us a try, or if you're already using us, we know what we're doing. You can either go to the type your message box at the bottom, and we'll call you back. You can complete a decision in principle form, which I think has already been sent to you. Normally they're sent around midday now. We send them to everybody that attends. Go to the website and submit cases online. There's a different submission form for each product, or just give the team a call. They're ready to take your call. If you're on LinkedIn and we can find you, if your name's John Smith, we might struggle. But if you're on LinkedIn and you and I are not linked on LinkedIn, you'll probably receive a request from me. If you don't, then send one to me and I'll happily accept. It's just we're trying to build a network on LinkedIn to keep you updated with what's going on in the market more than anything else. And if you like what you've seen today, you will have received this today, which is our agency application. Complete and sign that. I don't need it to accept business from you, but I do need it to pay commission to you. So that's the only other time I'd have to delay payment of commission is if I don't have one of those, because we have to have one at completion. And future shows, we've only got 2 left. Can't believe there's only 2 left. The year's gone absolutely flown by. 6th of October, we've got Family, Hampshire Trust Bank, Glen Hawk and Selina. And on the 3rd of November, Intay, MFS, Pepper Money and Shawbrook. All covering, as we always do, different products on each one. So you're not listening to 4 lenders all talk about bridging and how fast they are. So you can sign up for as many of these as you want. We're going to announce our 2023 shows probably around November time. So keep an eye out for that. Feedback and CPD. This is how I mentioned earlier on what you need to do. So just go to the top right corner. It says event board, and then click the red exit event box. Complete your feedback form, and then afterwards your CPD certificate will come out. If you haven't got it by tomorrow lunchtime, just pop us an email and check your spam first of all, but pop us an email and we'll get one out to you manually. About 10% for some reason still don't manage to go through, and we still have no idea why. Feedback, please help us out. If you've liked what you've heard today, just go on to Google and either search Google Review Specialist Hub or Trustpilot Specialist Hub and leave us some feedback. That'd be much appreciated. These are entirely put on by ourselves. We don't charge our lenders for these, and also we don't charge you, delegates, for attending. It just helps us to build our Google and Trustpilot reviews, which can be invaluable, obviously, to us. And a big thank you again to today's sponsor, Yorkshire Bank Commercial Mortgages. Sorry, Yorkshire Building Society. I do it every time. Yorkshire Building Society Commercial Mortgages for their sponsorship today. Much appreciated. Finally, thanks for attending. Enjoy the rest of your day. Stay prosperous and most of all, stay safe. And we'll hopefully see you next month. Thank you very much indeed.